take a break for Q&A. And okay, we're live. Welcome to the June 5th trade alert. Today we're taking profits on our TLT put option, which helped ease the pain on the bond sell-off. And we're putting in a new upside blow-off top hedge on VXX. So let me jump right into the trade alert. And again, post your questions in the chat box as I'm going. I have that up on the side. And we will take a break at the 1 hour mark to review how to get started if you're a new member. And then after that, go into much more detailed Q&A. Okay, so let's start off with the instructions for existing members. The first step today is to sell to close the 6/5/2020 157.50 TLT put. And we're going to roll that over into the 7/10/2020 153.50 TLT put. Now this is one put option per 100 shares of the TLT ETF. And right now the TLT is trading at 153.89. So this essentially locks in a guaranteed price tag of 153.50 per share of the TLT you own, no matter what happens to the TLT in the future. If it drops to 120, to 100, it wouldn't matter because you own that put option. Now the new trade today is per $37,500 following to buy to open two 8/21/2020 $27 strike VXX put options. So let's jump into the trading plan and review how this all comes together. First of all, let's just review the webinar teaser. So the big hit today was this spike in unemployment. Instead of there being 19% of the population or of the working force unemployed, it was only 13.9 this morning. So that was a huge surprise. And there's your supposed V-shaped recovery. We'll go into whether I think we have a real V-shaped recovery as we progress through the presentation. But I want to warn investors that the last thing the stock market really needed right now was a shock of good news. This may seem counterintuitive, but the only thing that's been driving this market higher was historic levels of money printing by the Fed. And now coming up next, more quantitative easing signaled from the ECB, Bank of Japan, and the Bank of China. And so in this chart, we can see what's so different this time. Typically, we don't do a whole lot of money printing when the recession begins. We wait till we've, again, raised the money for the government, plugged the holes in the ship, and then we turn on QE to form a bottom in the stock market. So this time around, the crash was so intense that they had to do QE to protect the bond market within the very first days of this recession beginning. So we can see in these lines below the last several crashes that the Fed did wait quite some time to roll up the quantitative easing out of these big banks' hands who buy up the government debt. And so the risk of doing this is you crash your bond market. So that's what I was warning could happen with too much QE. And right now that bond market is crashing. So that's very bad news for the longevity of this stock rally because we got to ask ourselves, did we really fix the underlying problem of the economy? I'm going to argue that no, we're not even near that point in time. So what comes next is the bond market sells off until its yields become too attractive and causes a flood of capital to sell stocks and buy a never-ending supply of government debt. That's not just US debt. This is a global problem that every country is issuing massive fiscal stimulus to try to get their economy back on track. So what were we expecting? I thought we get the bond crash in May and that we would be leading into a sell-off in stocks in June. But here it comes full force in June, 1 month delayed, just in time for a massive treasury issuance next week of $309 billion. And don't forget, the Fed surprisingly cut the bond QE by 70% 2 days ago. So there is literally no help from the Fed to pick up all this debt hitting the market. That's what's spiking yields. And this is what we were expecting to happen for all of our forecasts. So the Fed will really have two choices here to deal with the bond market imploding. Either the Fed will need to resume its treasury purchases in the coming weeks and begin what they've been signaling they would do, yield curve control, which will grow its balance sheet at rapid pace, or the bond market snaps all other markets as its yields rise too high in the coming weeks. The best measure of stress in the US banking system will be observed, seeing how much repo is used daily. And while they were doing the massive QE, there was zero repo. This morning it spiked to 106 billion. Earlier this week it was at 50. Last week it was in the 20s. So the US banking system is out of cash, and this is going to get progressively worse week by week because the debt supply from the US government is nothing short of uh, devastating to the markets. We're nowhere near selling all the debt we have to sell for the deficit this year. This will be the big thing moving forward. So there's your repo this morning of $106 billion. And again, this is showing the banks are out of cash. Okay, so how do you follow our trading plan? It's very easy. Step one, per $37,500 to invest, buy the following: 100 shares of the TLT ETF. Okay, my target is still $180 plus by the election. This is your deflationary hedge. Okay, I got a couple questions. Michael Seebeck says, what does this mean for our TLT? This is what I was expecting to happen last month, Michael, and that's why I bought that 1 month put, but it did take a bit longer to snap the bond market. So here we go. This is exactly what I was anticipating would occur. Okay, so step one, you want to get 100 shares of the TLT. This is your most important position in our strategy. It represents the US bond market, and they are trying to sell trillions of deficit this year. And now we're already looking at another trillion from McConnell that they're looking at passing. So they're just piling on the debt. Now we're seeing the states are needing capital. So just the amount of debt the US government has to issue in the coming years is absolutely breathtaking. So here we go. The bond market is starting to snap, and I'll take a look at charts. The best chart I would refer you to is look at 2018 before the Christmas massacre, and you'll see exactly what the bond market did to the stock market right there and forced the Fed to cut rates and eventually go into QE. So that's the single most important portion of the portfolio, 100 shares of the TLT ETF. And again, this is a deflationary hedge. This is something that you want to buy if you think that growth is going to be muted. They're going to have high levels of unemployment and a limited economy that is fueled by the government trying to bail out everyone. Okay, so that's your step one. And again, all of these positions are protected with puts, which makes it very hard to lose money. Step two, the bear steepening in the yield curve is highly correlated to the Russell 2000 as well as HYG. So this provides a great hedge against our deflationary product in the TLT. It also comes with a hefty dividend every single month, which finances our downside protection. So right now we've seen the tech stocks roar higher. They've been pushing banks higher on hopes of higher interest rates. And now we're starting to see the Russell 2000 get shoved up higher. So this is what I'm saying as part of the market manipulation to try to recover the total equity sphere is critical. They do get HYG up. My max target for HYG is 97.50, and currently we're trading at 84.74. So we still have a good amount of room for this to appreciate. GDX is our quantitative easing hedge. So again, the Fed's going to have a difficult choice. Do they allow the bond market to crash, which has 16 trillion outstanding, and could completely stop the US government from being able to sell its debt? Or does it go into yield curve control? If it does decide to go into yield curve control, which I believe it will do, but not until we have the next leg down in stocks and a ramp up in the TLT, then GDX will be your best friend because it is highly correlated to the amount of quantitative easing. Okay, the next position we have, okay, I do see some questions about the VIX. So yeah, well, I'll cover that as well, Oscar. Good question. Okay, next position is US oil. We're looking at oil companies going bust until the price of oil gets to a profitable range. And so our target for USO is to get above 60, currently trading at 28.93. And this does remain one of my favorite positions in our total portfolio in terms of quick opportunity to make money right now. Step 2, we need to protect our positions with put options. So I've given ourselves another approximately 35 days of running time for the bond market to have volatility by purchasing the 153.50 TLT put expiring 7/10/2020. Okay, so quite likely we'll be selling this in the middle of June, expecting the bond market to continue crashing until it becomes a pivotal movement in the market, changing from flows to equities and back into bonds. For the HYG position, we have the 626 put protecting us at the 77 strike. For GDX, we currently have the 28 GDX put. Now remember, several weeks ago, I was worried that gold would sell off with the stock market. And so we still have open our 35 strike GDX put. We have not sold those put options yet. And then the final put option to protect you is the USO put option at 20. And this is protecting us all the way to January 15, 2021. So this is the core of your portfolio and the put options that protect it. Next, we're going to look at two different hedges we have that can play out profitably with what I'm seeing coming down the pipeline. So the knee-jerk reaction right now is that the big CTA followers are getting punished on their bond positions. So I'm expecting that these trend following CTAs are on the verge of dumping a massive amount of bonds and pumping all that money into equities for what I'll call the blow off top. So this is your 8/21/2020 27 strike VXX put. This is two put options per $37,500. Expect to sell this within the next 2 to 3 weeks for potentially a very large profit. So you can look at the VIX as a leading indicator for where VXX is headed. And again, if I'm right and this bond market does start to tank, we'll have a limited opportunity to play this blow off top here in the coming weeks. Now, if the Fed jumps in with the yield curve control early before the stock market sells off, then we have a totally different picture. That could essentially pause the TLT where it's at, potentially bump it up and give the stock market more room. Now, the problem is that the dollar is now beginning to crash. So they are testing the limits of what they can get away with too much QE. So remember, everybody kept asking, what's the problem with doing unlimited QE? Well, the answer was you crash your bond market and thus your currency market. And so that's what's finally starting to crack right now, and what I exactly figured would happen to cause the stock crash. So this is playing out to the T. Step 4 is your stock crash put options. These are based on lots of $75,000. So again, this is a half position relative to the other positions above because it is based on lots of 75,000. And so we still have that same group of put options. Now, while we might be happy with a 200 to 500% potential return on a blow-off top on the VIX puts, the potential for a stock crash is monumental right now, and the potential return on these are 500 to 5,000%. And we have 3 put options for you: the 717 225 QQQ put, the 918 2020 230 Apple put, and then the 20 put options on the 1120 31 strike FXI put. So let's just talk about what each of these are. QQQ is the concentration of wealth in mostly the FANG stocks, and they are well above the valuations we saw in the dot-com bubble. So this has blown past the valuations in 2008. We're now looking at dot-com valuations, and then add another 30% for how extremely overvalued the QQQ is currently. Apple is essentially a play that China is going to retaliate against the United States when we cut off Huawei from semiconductors. So Huawei is China's big phone producing company that's raced to the top in the world by selling phones under cost and subsidizing that at a government level, which is really what this trade war is all about, is the Chinese taking over markets, subsidizing it with the entire power of the country, and putting out global competitors in that manner. So the United States is striking back. There's currently about 60 days until we cut off Huawei from semiconductor chips, which essentially will chop that company's legs off. So their retaliation quite likely will aim directly at Apple. So that's why we have the 230 Apple put option. And finally, we'll look at some documents that came out of the White House just yesterday. Trump put out his memorandum, which went into detail about why we need to essentially force Chinese companies to audit, and if they won't audit, get them out of the US stock exchange. So we have a new piece of news to look at that, published last night. And the bottom line is FXI targets Chinese equities, which I believe are going to be kicked off the US stock exchange as we head into the election. So those are your 3 puts. Now, for old members, we still have the set of SPY put options. We have not sold those. So you still have these 5 SPY puts, which again, I will tell you when we're going to take those off the table, but again, not for quite some time, as we need the bond market to work its magic for these predictions to play out. Okay, so that's a quick review of these positions. Let me take a quick break and see what questions we have. Then we'll review the performance and jump into a lot of extra news here. So let's see what we got. Yeah, Karen says nothing to sell on the June SPY put. That's correct. So that's why we're not selling it. Tyler got in for 360 on his TLT puts. Very good. Dean got his VIX puts for 360. Very good. Jack Tan says, if you think the bond market's going to crash, why are we holding our call up? So yeah, Jack, the prediction here is that the bond market will temporarily crash and then take down the stock market and rally right back up. So I'll show you some charts of that. But yeah, right now is not a good time to sell call options on the TLT. So we've already had the majority of the pain in those positions. And so yeah, we will we're going to have to wait to sell those call options on the TLT now. Okay, Oscar says, so are you anticipating the VIX to head down? This goes against the thesis that the market is going to crash. So once again, my expectation is that the CTAs are going to be forced out of their bond position right into no QE. So we're going to see yield spike, and then that's what's going to crash the stock market. Ed Portman says, is it possible that the interest rates need to be raised? Is that your question? Michael Seebeck has his VIX filled at 355. No, there's zero chance they can hike interest rates. Absolutely not. Okay, very good. Keep the questions coming. So how's our performance doing? We're down 7% for the year. We have a 1.25% drawdown in June, and we've been a little early on predicting the stock crash, admittedly. So I was thinking that we'd have the bond quake in May, but now it's starting to play out in June. So the predictions still continue to occur as expected, just a little bit delayed. So uh, overall forecast has not changed. And I do want to point out one good piece of news that's a mistake on my end for our bootcamp members. And thanks to Keith, I can, he's been, and another member too, I forgot who it was, been going over and over the Hong Kong trade, which I do want to review right now. I'll pull that up in 1 second. So this is a very important hedge for our members to place immediately if you're in the boot camp position. And so the Hong Kong dollar is at the tight end of its trading band at 7.75, which means it's extremely hard to lose on this trade. I had been telling our members that 1 pip is 0.001. However, it's actually 0.0001. So you have to go to the 10,000th place. So that means if we simply go from 7.75 to 7.85, you're looking at doubling your total investment in that trade. So 100% return if we just move 0.10 on the Hong Kong trade. So it's actually 10 times more profitable than we had been telling members. And that's a mistake on my side. So we'll cover that in more detail, but I did want to clear that up. So this is a extremely lucrative trade to buy to open the USD against the Hong Kong dollar, which is again at the strong end of the band. And we're about to start putting financial pressure on Hong Kong and China. Okay, so let's take a look now at what's going on causing all this. So first of all, the repo has been spiking. This is what banks do when they don't have access to QE and they've run out of capital. They hand over their treasuries or mortgage-backed securities to the Fed and in return get cash. So we've been carefully monitoring this for signs of stress in the banking system, and today it has spiked to $106 billion, which is good. Now, what's causing the economic turmoil? That's really important, right? So we just shut down the economy for 2 months, and we have not seen the effects of that yet because the government went and bailed out everyone. So in the next coming weeks and months, we're going to start seeing which businesses are able to reopen and maintain their employments and profit levels, and which are going to fail. So this is all coming down the pipeline now. But the reason why the economy was shut down was because there was a fear of a deadly virus that spread from China. Now, if we go look at Trump's speech last Friday, what did he say? He said the Chinese purposely allowed the pandemic to spread around the world, lied to the WHO, enclosed Wuhan from all of China, but allowed the citizens of Wuhan to go travel the world freely to ensure that there would be a global catastrophe. And it worked. 100,000 Americans are dead, make that 110,000. And so far, there's been absolutely no retaliation, just a lot of barking. So we'll take a look at what came out of the White House last night. But it looks like two things are happening behind the scenes. Number one, we're discussing with all our allies a reparation demand from the Chinese. That's one. And then two, it does look like we're going to move towards forcing their stocks to either allow American auditors in, which is against the Communist Party's. Tyler says better than expected unemployment numbers today. Yep. So what's coming down the pipeline in terms of US-China relationships? Well, first of all the tariffs that are applied to China are soon going to be applied to Hong Kong. That's number one. Number two, once we read the White House's memorandum from last night, they're now going to force Chinese companies listed on US stock exchanges to be audited by American auditing firms, which again, the Chinese will absolutely not allow because it reveals the power structure of the Communist Party. So that's just not going to happen. So what is going to happen? Most of these companies will have to move to Hong Kong as the or London exchange because they most likely will refuse to have these audits. So that's why you want to have that FXI put. Let's talk about what's killed the economy and whether or not we think it is anywhere near completion. So we did a 2-month lockdown, essentially, globally, and we're able to flatten the curve. Now we've got some people wearing masks, some people not. We've got riots all over the world, tens of thousands of people gathering. Many wear masks, many don't. So we've got to ask ourselves, have we really defeated the virus? Is this going away? Or is it going to come roaring back into the end of the year? And so the best data I have is the tests out of Florida. They have now tested several 100,000 for antibodies, and the percentage of people who are willing to go drive up, have a syringe pull blood out of their body, and come back with antibodies is running at 4%. So I think that's the highest level of antibodies the US population has currently. Probably it's half of that at best, because you got to think, unless you are really concerned or believe you've already had it, you're very unlikely to go to the trouble to go get an antibody test. So I would argue that at the best case, 4% of the population currently has contracted the virus, and that unfortunately, without more social distancing, without limiting the economy, without limiting transit and travel, this is going to come roaring right back in the next 90 days, which is handy because that's exactly when AstraZeneca and Moderna happen to be running their phase 3 vaccine trials. So they're going to have plenty of candidates to be exposed by the virus to see if the vaccine works or not. Okay, so that's part one. Part two is, do we believe that this was simply unwarranted? Is the virus not as dangerous as the media made it out to be? And so here's the important data on that. Perhaps it's less dangerous for people under 45. That I believe is true. But if you're over 45, it's extremely dangerous. And so these are the charts that really put down any question as to whether or not this is extremely dangerous or not. And so we can see right when we should have had a massive drop in deaths, we had a historic high increase in excess deaths leading into the summer. So my prediction is because the US economy must reopen, it's going to do its best job. It will have to be somewhat muted, and that the excess deaths are going to come right back up into the close of the year. And this may cause a lot of Democratic-based governors and mayors to refuse to loosen up the restrictions for their economy. So more pressure against Trump leading into this election. So there's your United States excessive death jump. If we go to the next chart, this is 24 European countries. Everybody's watching the Sweden data come in, and now we're seeing that Sweden, which tried to avoid any kind of social distancing rules, kept schools open, never shut down their economy, is now having 3 to 4 times the death rate per million people in their population relative to surrounding countries. And so yeah, the bottom line is the disease in the economy is not gone. We're celebrating the results of a 2-month lockdown. and we're facing the fact that we can't remain locked down for indefinitely. So that's the update on this. Now let me jump to what came out of the president's office last night. So all week I've been saying, look, we got a lot of bark out of Trump about China. Where is the bite? And why is he waiting? So this did come out yesterday. This is memorandum on protecting United States investors from significant risks from Chinese companies. And so it's a bit of a read, but the key highlight is essentially that the United States stock market has different rules for American companies versus Chinese companies. And this is leading to fraud and is not fair to US investors. So essentially this goes through this in great detail and signals that if the Chinese companies will not avail to a US auditor, then they will be kicked off the stock exchange. Okay, so I'll post this link for everyone if you do want to read it in detail, and it is in your, it is located in the news tab as well, which we're about to jump into. Okay, see, I see a few questions. Ram, does that still need to get voted in Congress? So Congress does have some bills similar to this, but yes, it looks like we're headed towards the direction of kicking these companies out of the stock exchange and beginning a great decoupling. Which I do believe is the really the only chance Trump is going to have going into the election, is to make China the enemy and correlate that to Joe Biden, who's now blowing away in many polls. Okay, Ron says, with the VIX down and we're planning a new drop, can we not start playing the SPY married put and short calls? No, yeah. So I would wait to buy the SPY until we have collapsed 50%, Ron, at least. That's when I think the Fed will start doing yield curve control, and we'll have another big stimulus plan. Okay, great. Let me get into some of the top news. Let's start off by looking at the Fed's balance sheet. So this is what's been pumping the stock market up, is the Fed expanding its balance sheet. And the news yesterday is that we have the smallest increase in the balance sheet since the crash. And they have unexpectedly decreased the US Treasury purchases, almost as though they're trying to create a volatility spike in the bond market. Now, they said they did this because no one wanted to let go of their treasuries this week, although the action in the last 48 hours would signal that there is selling pressure currently, which again, the higher that yield goes, the more expensive debt becomes to the government. Plus, it creates an avalanche of selling. So you have $16 trillion at risk of leaving the US Treasury from external foreign investors if they're not careful with the quantitative easing. So there you go. That's why they've cut the QE. Where has the money flowed? We've got essentially 24 billion to repurchase agreements with foreign marked as others. But we also saw them pick up 6 billion for the Paycheck Protection Program and another 5.7 billion into the corporate credit facility. So that's really your LQD and your HYG, the two positions we're playing. So yeah, I'd much rather have HYG when I believe we're near a dot-com bubble crash run, because HYG gives me free put options and it's trailing way behind the general stock market. So if we were to assume that they were going to manufacture a stock market rally into new highs, they absolutely positively must bring up the Russell 2000 and that bond market, which is HYG, for any kind of sustainable rally from here. So that's our equity exposure, is to play the corporate bond high yield market, which is what the Fed's currently buying and not the SPY. Okay, so that's what happened in the Fed's balance sheet. Here is, again, the unique thing in history is doing QE before they fixed any problems. They did that because the bond market failed its job. The bond market in March was supposed to protect all the downside in equities, but because there was such a great collapse in oil and stocks globally at the exact same time, the central banks ran out of cash. They had to cover very negative positions, and they ended up tanking the US bond market. So that's why, if the Fed had not come in with QE, not only would have the US stock market collapsed, but also the US bond market, which means the dollar can collapse and the US government doesn't raise a penny. So you got to remember, the US government is the most indebted government in the world, bar none. And if we're not very careful, the credit line to the US government will be cut off. And that is the only thing propping up the US economy, period. So there's the historic jump in assets for the Fed's balance sheet. And now, most likely, we'll watch this topping off and probably start to go back down, as a lot of the debt they picked up was very short term debt that'll roll off, T bills. Okay, so what are the inflationary expectations? That's the main problem with too much QE. I'm still betting we're going to have deflation, not inflation. We have a huge chunk of the population unemployed, despite giving out almost unlimited capital to companies to avoid firing people. What's going to happen when you cut off the free money and allow businesses to fail? So, my expectation is something more like the 1929. Let's go back to those roaring 20s. This is very reminiscent of the 1920s. So you had a decade-long stock market rally that went straight up. Nobody thought it would ever crash. You started having deflation, and then it went into negative deflation. You had the Great Depression. So if you have too much debt and that debt becomes too large, that's exactly when you end up in a deflationary spiral. So I do perceive this as exactly what's coming down our pipeline at this moment in time. The other period of time we want to be very aware of would be the opposite. So that's 1965. So right after World War II, we went into another spending spree at the government level, racked up massive amounts of debt, had a great stock market as long as the inflation rate wasn't too hot. But by 1965, that came to an end, and we went into the inflationary period from 1965 to 1980. Paul Volcker had to hike interest rates to get the inflation out of the economy, and you ended up with the bond market and stock market crashing during that period, and gold was your hero. So where are we at currently? Well, right now the signs are deflation. So we'll be keeping a close eye on this, and again, updating it each month. Now, here's the chart of the different crashes we've had over the last century. And so you can see when the Fed thinks there's a crash coming, they cut rates significantly. And then typically you have a recession after the recession has been cured by issuing bonds and, again, fixing the holes in your boat. Then they come in with QE, buy up the bonds from the banks for a big profit, and those banks can turn around and prop back up the stock market. This time around, they did the rate cuts, and the bond market failed. It was not doing its job. They had to come in with QE. So we have a very distorted market. We have stocks going, we have the NASDAQ going to new highs. We have the S&P 500 approaching its February high. And obviously the economy is not recovered. And there's really no easy path to recovery at this point without a vaccine, because we've only had 4% or less of the population become sick. And now we're trying to reopen the economy without the proper testing. And the opening we are having is extremely limited. So there's just zero chance that the 2020 or 2021 economy will be anything resembling the 2019-2018 economy. So we have a asset bubble right in the middle of a recession. So again, this has played out 100% to the T. Every time the government has to blow out its deficit, the bond market ends up crashing the stock market. And that's what you can see in each recession, accompanied by these rate cuts. Here is your Dow over the last 100 years. And again, roaring 20s, everybody thought it would never end. It was not sustainable, and you had the worst stock crash in history. This was approximately a 95% crash from top to bottom, 1965 through 1980, another period of time. You had great stock market rallies fueled by debt expansion after debt expansion until the debt became too great, and you had runaway inflation. You had a 30-year period in 1965. Had you bought stocks thinking that it would never stop going up, you had 30 years to break even. Okay, so the next few indicators I want to take a look at is the gold copper ratio. So copper was giving us a warning that there could be a spike in interest rates, and we got it. Now again, got to ask ourselves, is there a real recovery, or did we do QE in the middle of a crisis and we're getting distorted information? I would argue that we're having distorted information. The economy's not recovered, and that QE is giving out false signals. Okay, so a lot of people are asking, why didn't I have the VIX puts last week? We would have made a fortune on it. That's correct. And Kathy's saying, what indicates the VIX will continue down? So yeah, right now what I'm expecting to give us what we're going to call a blow off top. So let's look at that 1920s, for example, the roaring 20s. My expectation is we're going to have the CTAs, which control a large amount of capital, essentially being forced to liquidate their bond position and then go full throttle on stocks. And so I do believe there is a considerable risk that the market could shoot up much higher in the coming weeks until the bond market essentially cripples it with its yield spiking so high. So I thought all of this action was going to happen last month. It's now playing out this month. All right, so we have the gold versus copper. Again, copper tends to go up when you have healthy economy and growth. You're building things, and gold goes up when you're busy printing too much money and creating inflation, called QE. Here was this divergence in the copper versus the 10-year treasury, and now that 10-year treasury is rocketing higher right now, causing forced liquidations. So really the question now is, will the Fed increase its bond buying next week, which would push the stock market much higher and elongate this move, but potentially weaken the dollar even further? Or are they going to allow the bond market to essentially crash and take down the stock market with it, and then begin yield curve control after we've had a new leg down? Navish is asking if I think the SPY will reach 340. Should we sell our SPY puts and buy it again? No, I would just hold on to your SPY puts. We have a lot of time premium on those, and we have new put options you can jump into today. So it's hard to predict exactly what percentage of a increase in yields will cause a crash. I'll take a look at the charts in 2018 so you get a feel for it. But over time, the stock market has been able to swallow less and less of a yield spike in the bond market. And so once we see that, it's critical for the TLT to stay elevated for stocks to rally it's going to be really up to the Fed. Do they want to keep this bubble expanding and continue weakening the dollar by reintroducing QE next week? Or are they going to allow the bond market to essentially spike in terms of yields, in which case that will, without question, crash the stock market? Okay, so here's United States GDP. It's going to be a horrific number. Probably we'll be seeing GDP at levels last seen in 2017 or 2018, but the difference will be the deficit will be much worse relative to the previous years. So the goal is generally to try to create GDP without that GDP growth being greater than your deficit growth. This time around, the GDP growth is going to be massively correlated to a shock in the government deficit. Here's a look at the United States GDP annual growth rate. And again, they're expecting next quarter to be negative 50%. So that is not printed in here yet, but that's what I would expect. Okay, Karen says, could you clear up your projections for the TLT? Yeah, so let's go look at the charts. Okay, so let's take a look at the TLT versus all right, so let's look at the big picture. So in general, we've been able to watch the US stock market get through two crises, in the dot-com bubble and the 2008 crash, and have overall, really since Paul Volcker came out and Alan Greenspan came in, we've had one massive stock market rally, but that stock market rally has been funded by the expansion of government debt. So in the red line below, that really represents the expansion of US debt, which has been pumping up the US GDP and creating these profits for the corporations. So the problem here is if we allow the TLT to drop, that represents the cost of funding to the government raising and essentially a reduction of our ability to borrow. So these two must go up together, otherwise they will both go down. And so that's what we're seeing exactly right here. So we're seeing the bond market sell off and this massive rally in stocks completely fueled by QE. So let's go back to, I'm going to zoom in now, and so we can see this relationship. The last time we had yield spike too high in the bond market. Okay, so Trump's elected. He actually had a great economy. Corporate profits are cut. He was still blowing out the deficit, but everything was gravy. We thought we had a trade deal with China. I mean, it was make America great again, right? And so what happened? So down below, you have your TLT crashing until what happened? Till the stock market tanked. So what happened here was the 10-year hit 3% yield. And that was the limit. That was the biggest change of yield that the market could price. And so if we look at the start of 2018, that was a total decline in the TLT of approximately 10%. So a 10% move in the TLT, or in long interest rates, caused a massive sell-off in the US stock market from really from this point onward. So let's go to here, zoom in some more. So this is exactly what was expecting to happen last month. That's why we had that longer than normal put option. But it looked like the market was just going to protect that bond position. Today and yesterday, we saw that really let loose as the Fed tried to pull back the QE. So the QE was allowing the expansion of debt and allowing the S&P 500 to continue rallying. And so there you go. That is exactly what I'm expecting to happen right in this picture here. So we saw the TLT drop from 7.6% at this level to as low as negative 7% during a extremely healthy economy when nothing was wrong, and created a from the top in the S&P 500 was a 22 down to 0. So we had a 20% sell-off in the S&P 500 caused by the spiking yields in the bond market. Okay, now the more debt we pile on to the government, the more hypersensitive the markets become to prices, to yield change prices. So let's see what kind of drawdown the bond market has pushed in so far. So from the recovery after this move began, depending on where we look at it. So here's where the TLT was doing its job in March. And this is where everything broke. So you can see the TLT had risen to a 25% relative return and more than protected the drawdown on the stock market, which you could see at that point in time was 12%. Then things snapped, and I believe this was because of too much exposure, too many derivatives, too much naked selling. And all of a sudden, the TLT crashed alongside the stock market. That's why the Fed came in with QE, because if it had not, both the stock market and the bond market would have collapsed at the same time. So what's happened? Well, we came in with $3 trillion of stimulus, primarily pumped into the US bond market, and we got a big stock rally. But now they're not doing that. And so we're back to that same scene. And let's look at the volatility we've seen from this level. So it's gone from a relative 18% down to 6%. So that is a 12% move. And yeah, so that's very close to the move we saw in 2018 that snapped the stock market. Okay, so I've got some questions. So Ed says, should I wait to buy the TLT since I have some puts? No, I wouldn't, because you have the in-the-money put option on the TLT. So we paid, let's just look at the risk reward on that trade. So with the current trade alert for the TLT, we're buying the 153.50 TLT put, and we're trading at this moment at, well, I guess it's gone up a little bit, at 154.42. Okay, so that means you get no less than 153.50 a share, no matter how low the TLT goes. Number one, but number two, we had to pay about $3 of premium for that position. So that's about 2%. If the bond market does what I believe it will do and crashes the stock market, this is going to rip right back up towards 180. So I don't mind paying $3.50. What did everybody get filled on that TLT put for? So you're basically betting that in the next month, the bond market will take out the stock market and the TLT will go up greater than the cost of your put. And if we're wrong, then really we're losing the cost of the put and nothing else for that critical position. So I do believe we can wake up one night and the TLT is dramatically higher and you wouldn't have that opportunity to jump into it. So that's one. Two, let's say the Fed next week says, okay, we see this crisis. We're going to go ahead and resume QE next week. That's really the only thing I believe that can keep the stock market rallying higher would be a decision from the Fed to, okay, so Karen says, but the Fed was increasing interest rates. That's fine, but it doesn't matter. It's the change of interest rates that takes the stock market out. Okay, so Kathy got her TLT at 295. What did everybody get filled in on your TLT position? $3, 280. Okay. 305. Very good. So yeah, so Karen has a good point. The Fed was trying to, they said it was going to be like watching paint dry, one, and then two, they said they're going to be reducing the balance sheet. So anybody who wants to protect the dollar and have a healthy economy without zombie companies and trillions of dollars of deficit, love that idea. But what did it do? It crashed the stock market within 9 months, and the Fed had to instantly reverse course. So I do believe the Fed is going to do more QE, which they're going to call yield curve control, but I don't believe they're going to do it until this plays out and we have another leg down in the stock market. So let's just look at the two outcomes. So we have a guaranteed supply of debt that's going to drive yields higher and higher without question. That is absolutely not going to change. Okay, so that is a matter of fact. The government's not going to go reverse the 3 trillion stimulus bill. They have another trillion already planned. So we can count on there being a massive load of debt for the foreseeable future. So that's one. And now we're starting to see all the states need to borrow from the government. Okay, so that's one. Two. So that we have two outcomes for the Fed. Number one is they're going to allow the bond market to snap and take the stock market down with it, and then go into yield curve control. So that's what's happening right now at this very moment. This is what I thought was going to occur last month. Now it's happening. Option two would be to reverse course what they've done for the last several weeks, which is to dramatically decrease quantitative easing. So if we get a note this Friday that the Fed's going to come in and reverse course, we're going to not drop our bond purchases, we're going to ramp them right back up. If that happens, let's look at how our portfolio is positioned. Okay, so if the Fed decides to prop up the bond market, TLT most likely will go up slightly, but just stay range bound. That's what we call yield curve control. HYG will fly up. GDX, because of QE, will fly up, and oil will continue to rally. So we're well hedged if the Fed comes in with more QE. And maybe we have a secret pact with the UK or the Eurozone and Japan to be buying up our bonds. Now, clearly, it doesn't seem like that's working right now because yields are spiking. So it's really important that this is exactly what I was believing would happen last month, is that the bond market would spike. That's why we had that longer duration put. It didn't happen. Now it is happening. So this is exactly what I was worried about. And so it took how many weeks? It took essentially 5 weeks of no QE for the bond market to snap. And they've sold approximately 1/3 of the record 3 trillion they're trying to sell over this period. So they're only 1/3 the way done. And now they're again starting to promise another trillion in stimulus from McConnell just yesterday that he believes will be approved after the July break. So towards the end of July, we can expect another $1 trillion to be thrown into the bucket. And with no Federal Reserve to buy up this debt, yields are going to spike until it takes down the market. So if the Fed reverses course from what they've been doing for the last four weeks, which is stopping the purchase of bonds, then I'd expect the TLT to just flatline. We're not going to lose on it. And again, we have the in the money put. So the TLT is locked in. Your P&L on the TLT is locked in terms of the maximum loss by buying that in the money put. And if what I believe occurs, we're going to see a huge spike in the TLT, and quite likely all four of these assets sell off. Now, again, the strategy here is we have an inflationary portfolio, which is the HYG, GDX, and USO. And then we have a deflationary half of our portfolio in the TLT. And if the stock market crashes, guess what? We have put options sitting nice and tight to protect the inflationary products, HYG, GDX, and USO. So that's the general strategy. And we have some extra options trades to help protect that even more, which again, if we do see the bond market puke, which I think we may see next week, where's the money going to flow into? It's likely going to pump the stock market much higher for a blow off top. So that's why we have the volatility play. And we don't necessarily need the market to go higher. We just need it to trade flat and for the VXX to catch up with VIX. So VIX is looking at the front month of the volatility futures market, and the VXX is a combination of those. So this one is a lagging. So really the best result for the VIX position would just to be trading in this range for the next several weeks as we watch that bond market implode, and probably you'll see the smart money starting to pull off profits in every equity position they have that's overvalued. So we'll look at some key indicators to get a feel for when we're getting near the crash moment. Okay, so does that make sense for everybody? How this strategy works between the two? Okay, looks like everybody got filled. Let's see your VIX put option fills as well. Why July 17th instead of July 10th? So yeah, I think it won't take to the 17th for the bond market to snap the stock market, Karen. We're already seeing it begin to snap right now. I actually think the bond market's going to snap next week. So we'll be looking to sell that put much earlier than expiration. Okay, Bruce got the VIX for 359, Bill for 350. Okay, very good. We're at the 1 hour mark, so I'm going to go ahead and take a quick break and let Dean do a very general education for everybody who's a new trial, walk you through the whole system. Okay, Ernest got it at 360, review our different products we offer, and then we'll come right back and go into more Q&A. I've got a lot of news to cover. We haven't even really hit the tip of the iceberg with the content to present today. Okay, so let's go ahead, and I believe you will take the control, right, Dean?
Okay, can you guys hear me okay?
Yes, sir.
Okay, cool. And can you see my screen as well, Jason?
Yes, sir.
Okay, perfect. All right, guys. So just want to quickly call your attention to the screen here real quick. And my name, guys, is Dean Gallagher. I'm an investment consultant and partner here with Portfolio Builder. I specifically work with the people that are on our trials to help them understand what we're doing, why we're doing it, okay, and how you can help protect your nest egg with our services. Okay, so I want to welcome and thank you for taking the time to join the investment webinar, first off and foremost. Okay, guys, hope you've enjoyed the education so far. And if you guys have any questions about anything we're doing in the portfolio, please ask questions along the way. One of the really neat separations that we have from, the financial advisor out there, or potentially, the hedge fund that you may be invested with out there, is the fact that we will interact with you. Literally, if you go to our top tier, about 10 hours a week live, and really on our bottom week, our bottom tiers too, you still have 2 hours a week of live interaction and education. Your financial advisor is never going to educate you to the level we will. Your hedge fund will never educate you to the level that we will. Okay, so that's a huge part of the separation of what we do. Okay, so part of that educational process, right, guys? The smartest kid in every class asks the most questions, right? So don't be afraid to ask questions. Okay, and folks, we truly appreciate your time and attention to show you how boring successful trading can actually be when you have the right strategy in place. Okay, guys, so go ahead and meet the team here. So this is the Portfolio Builder team. On the left, that's me. My name is Dean. I'm a partner and investment consultant. Trial members, I'm your dedicated resource for any questions that you have during your trial. Okay, in the center, folks, you're going to see Jason, our founder and chief investment officer. He was the person that was just presenting all of the material. Phenomenal guy, certainly, one of my best friends, and one of the smartest humans I've ever met. You don't want to play chess against him. You want to play chess with him. Okay, so just really cool to have his knowledge and his intellect guiding us through this. On the right, guys, another one of my best friends too. You're going to see Ryan. He is a partner and technical director of our firm. Okay, so all the really cool things you're going to see that we automate to make things really easy for you, basically is Ryan's creation. Okay, so that's us. This is the most recent picture we all have together. We were saying we needed to get a more recent one before COVID happened, and so we're still kind of waiting to do that. But we'll get you an updated one. But this is on July 4th of 2019. Okay, so real quick, guys. The mission of Portfolio Builder: number one, engineer and build the safest gross for your hard-earned nest egg. Number two, educate you on how the central bank controls the market and attach your capital to it. Number three, answer any and all questions you have about our portfolios live in our webinar interaction, guys. So like I said previously, don't be scared to ask questions. Please just jump in there, guys, and ask away. Okay. So many of our members make the cost of our membership or more in a few weeks, and our trading plan takes less than 2 minutes to execute at noon Eastern on Monday, Wednesday, and Friday. My challenge to you is to see how much you can make over the trial. And I want to ask you, is there a better way to build trust? Okay, we follow two really simple rules, folks, when it comes to investing. Rule number one, never lose money. Rule number two, don't forget rule number one. Very, very important rules that I learned from the Oracle himself about a decade ago. And I wish I would have known these rules day one going into the investment world. Happy I know them now. Will certainly reduce your stress levels and your pain when you focus on not losing your capital before thinking about how much capital you're going to make. Okay. And so, very important rules. I'll never forget reading these. It was actually after a large loss period I had in my 20s, following a stupid recommendation from the Motley Fool newsletter on a company that actually went bankrupt. I lost a substantial amount of money. And I read every book Buffett had ever been a part of, all of his major interviews, and I'll never forget learning these two rules. So they're absolutely rules that we live by. Okay. And folks, the whole point of your trial is to help you quickly establish a defensive balance for your portfolio. Plus, you'll be ready to profit from a very risky time period with our trade engineering. Okay. Trade alerts will be delivered at noon Eastern via text message and email Monday, Wednesday, and Friday. We engineer our positioning in coordination with the financial system and macro environment. All you have to do is take 1 to 2 minutes to replicate the trade in your account. It's super simple. So we're going to watch the market, folks, 18 hours a day, 5 days a week with our team, okay, and also some software, right? And then we're going to produce the trade engineering. We send it out at noon. You just replicate it with your account. It's really, really simple, okay? And the neat thing, guys, is you're going to have full and complete control of your capital at all points, unlike the financial advisor and unlike the hedge fund. Okay, so that's really nice to have, that access and that control of your capital. Okay, things come up in life, and it's nice to be able to liquidate things immediately if you need to. Okay, that situation is much tougher if you're with an advisor or with a hedge fund. Okay, even a mutual fund. Okay, we're going to have live trade alert presentations, folks, Monday, Wednesday, and Friday at noon Eastern. You can access the live presentation from our trade alert email we send out. Simply click on the link, or simply click on the image that looks like a play button, and please ask any questions during the live presentation. Okay, so always, guys, feel free to jump in there, ask the questions. Also, if you're on a trial, or if you're one of our clients, you miss the live presentation, no worries, guys. You can actually go into your email, literally click on the same image and that same play button. It's going to automatically take you. Ryan's automated this. It's really cool. It'll automatically take you guys directly to the start of the presentation, and you can watch that on your cell phone. While you're going for your walk, or while you're doing your workouts, or whatever it is you like to do in your leisurely activity. Maybe you want to listen to it on your commute. Okay, but you're always going to have that recorded version ready to go. All right, guys, you can always access our track record by going to portfoliobuilder.io /track-record. We build trust with our clients by being 100% transparent with every position we've ever had. Okay, you can always access our track record by going to portfoliobuilder.io /track-record. Okay, real quick, folks, a few things that you're going to need to have in place to get the most out of your trial. Number one, a brokerage account set up to follow our trading plan. Okay, guys, it's going to be really important that you have options trading enabled. You can use real capital or simply paper trade. Then you can see how incredibly easy it is to give your hard-earned money the protection it deserves. Number two, you're going to need the ability to take 1 to 2 minutes to follow our trade alerts released at noon Eastern. These alerts are by no means time sensitive at all. They simply need to be placed before the market closes at 4 Eastern. Okay, and I've placed them right at noon Eastern on the nose. I've placed them 5 minutes before the close at 3:55 Eastern, okay, and kind of everywhere in between. Okay, so just make sure you get the trade replicated that day. That's going to be important, right? And if by chance, guys, you can't get the trade put in place the next day, just reference your trade alert the next day, or ask a question live in the webinar to see if that position is still okay to put on. Okay. Number three, you're going to need a mobile phone to receive our text message trade alerts. And I love this because email tends to get buried for me. My text messages do not. So many of our clients take these trades on the go from the airport, the restaurant, and the car, anywhere you have service. It's important to make sure you entered your cell phone number when you sign up for the trial. If you use the landline, email the cell phone number to ryan@portfoliobuilder.io, or simply type in your full name, cell phone number, and email to the chat box, and Ryan will add you to our distribution system. Okay. Number four, you're going to need an email provider that's in good working order. We send out the free webinar invites via email, and we also send out the trade alerts via email on top of the text messages. Okay, you can see how we smooth out the wave and avoid big drops in our positions. In December of 2008, the SPY fell 16.63%. Our pro portfolio made 1.17% profit. You can take a closer look at the numbers below. You can see how we smooth out the wave and avoid big drops with our positions. In January of 2020, the SPY fell up to 3.45%. Our SPY portfolio made 1%. The option protection did its job. Okay, you can see how we smooth out the wave and avoid big drops with our positions. In February and March, as you guys all know, okay, the S&P 500 fell off up to 34%, folks, while our pro portfolio and 2 trades from the boot camp actually generated 6.2% gain. Okay, so think of that on $1 million. You either had a $340,000 drawdown, or you had an increase of $62,000. I will absolutely take the latter all day. In closure, here's the nuts and bolts of it. We're going to show you how to be defensive, balanced, and profitable in this market condition unlike 99% of US investors. Jason, our Chief Investment Officer, will be covering the build out of this portfolio today live in the webinar, and he'll continue to do that every Monday, Wednesday, and Friday. Okay, so you guys just saw him do that. If you're catching this a little bit later, just feel free, guys, have Jason review the portfolio one more time. Okay, and you can always go back to your email too, folks. Literally just follow it A to Z. You can literally build the entire portfolio by just going through and executing each trade that you see in your email. It's super easy. Okay, and folks, we're going to help you be the investor buying when there's blood in the street and everyone else is scrambling to close out huge losses. Okay, you're now living in the most risky time period since 1929 as an investor. However, we're absolutely positioned to grow wealth safely as the dumb money decimates their wealth in this collapse. And I want to ask you, are you ready to get defensive and grow your wealth in this havoc? Okay, more people lost jobs in April than during the entire great financial recession, guys. Pretty wild number. And if you think about it, the great financial recession took 16 months to play out. The month of April alone, we lost more jobs. Okay, so how can we help you and your family? Okay, we have 2 portfolios that you can build with us today, depending on your investment capital. We also have our educational boot camp that will dive deeper into the education and deliver our high alpha trade alerts. Okay. So real quick, guys, understanding our portfolio options. So guys, if you have really kind of 30,000, but really less than 40,000 bucks, the buy and hold portfolio is great. Okay, this portfolio simply uses ETFs to be long or short specific asset classes. Okay, minimal changes are needed in the portfolio throughout the year, and we only made 5 changes in 2019. No options are used at all. This is super simple stuff, guys. One live webinar will happen every Monday. So you're going to have up to 2 hours to interact with us every single Monday. Okay. And the trades are done at 12 Eastern. In 2019, we had phenomenal returns on that portfolio. We did 25.31% ROI. Okay. And we had 0 quarterly drawdown during the year. Okay, understanding our pro portfolio. Okay, and folks, this is really for people that have at least $100,000. Okay, that you're invested into the market with, and really, it's really filling the gap from people that have 100,000 up to about 20 million in the market. Okay, because you can't get access to any of the good hedge funds unless you have about a $20 million allocation. Okay, and all of the best hedge funds aren't accepting money currently. Okay, so this is kind of how we're fulfilling that gap in that niche in the market, and there's tons of people looking for it. Okay, so in the pro portfolio, guys, this portfolio will show you how to trade like the best hedge fund managers in the business without the 2% management fee and 20% performance fees. Okay, changes will be made on a weekly basis to ensure maximum protection of your capital. 0 quarterly drawdown in extremely risky time periods. We've had profitable returns and market sell-off periods. Okay, most retail investors don't understand how to get there, and we've had a sophisticated balance of core asset classes. And it took us a while to find that balance, guys. But for you, it's real simply, you just buy the ETFs, marry that put option to it, and sleep tight at night. Okay, you're going to have 3 live webinars each week. We're going to teach you what we know. Okay, during those live webinars, and pro members really enjoy the exclusive content produced in the Thursday webinar. Okay, and really, guys, today it's pretty crazy. I keep telling Jason he's crazy for putting out this offer, but it's available to you, so take advantage of it. You will get a 1-year access to our $10,000 bootcamp free. Seriously, this offer won't last long. Take advantage of it now before it's gone. So give me just 1 second here, folks. I'm going to go ahead and paste the links in here to take a look at our pricing page and our options here so you can get started. Let me go ahead and post that in there for you guys. All right, guys, you can go ahead and take a look. Click on that link. It's a blue link that's in the chat box there. And you can go ahead and reserve that massive discounts that we have today. Okay, so in closure here, guys, don't let your hard-earned nest egg be decimated. Sign up for the URL in the chat box to protect your portfolio and profit from today's environment. Just click on the link in the chat box now to get instant access to the $10,000 bootcamp program, and it's actually for 1 year is the offer we have today, guys. So take advantage of that. Here's to your success and guidance to build wealth while the rest of U.S. investors get crushed. Okay, and just real quick, guys, if you're an existing customer, maybe you're on trial, and you're going to join today, okay, and maybe there's someone else we can help. Okay, we absolutely love referral business, guys. If you want to help your friends and family as well, simply refer a friend, family member, or loved one to us, and we'll send you an Amazon gift card, anywhere from $100 to $500, guys. Make sure they mention your name when they sign up, or call me, and we'll send you the e-gift card. It's really simple, guys. Love to take care of you guys for sending those referral clients over, and absolutely love helping your friends, your family members, and your loved ones. So thank you, folks, for your time. I appreciate it. Call me if you do have any additional questions. If you're on a trial, okay, 505-322-7515. Thank you so much, folks. Have a wonderful day. We look forward to working with you. Thank you, Jason.
Very good. Thank you, Dean. Okay, guys, I'm going to go ahead and keep going. I want to get into the news tab. I want to remind you, you have access to the same webpage I have on the screen. And up top, you have 4 buttons: trade alert, news, charts, economic data. So I do want to jump into the news. I'm not going to be able to cover everything, so you may want to come back to this tab and go through it in detail. So here's some of the videos that I've collected over the last 48 hours that are important. Project Veritas infiltrated Antifa. It's a 5-minute video. It has over 1 million views published yesterday. And this fellow gets into one of these Antifa meetings, and they're sitting there talking about how you need to gouge people's eyes out and what their general intentions are. I'd expect to see a series of videos coming out about this. So far, it's just this one quick little 1-minute video. Now, this is another video I picked up, which, again, we're trying to figure out what's going on. Why do we have riots and protests around the globe? Are we going to war with China? What was the origins of the virus? What will the reparations be demanded at China? And what financial sanctions are going to come to China? That's really the big questions that we need to be focused on in terms of key risks in the market right now. Now, this fellow has a good video. You're going to have to click it to get to the page. And it's a minute of total time, but he's paused and highlighted. And what you can see is that there is an old police car staged in the middle of the road by a gas station with a bunch of peaceful protesters. And he's sitting there recording it, and a group of people who have 100% of their face covered. So you have no clue in terms of being able to identify the Antifa group. And they come in a minute's time frame. 2 people come in with a skateboard, bust out the windows. Another woman comes in and sprays gasoline all over the car. Another man comes in and puts some sort of explosive in the car. Then they light it on fire and they get the hell out of Dodge, and the car blows up right in the middle of the street. And so it shows that there is indeed an attack happening on America right now. And so what is Antifa? That is likely something being funded by the Chinese or George Soros to create chaos. So there's a huge history of George Soros' open society trying to go create civil unrest and manipulate elections for his benefit. I do believe that's what's playing out right now. So I would recommend watching both these 2 videos so you can get the information yourself. In this video, they're talking about how the corporate bond market is now addicted to unlimited debt. We're not creating companies that generate profits. We're creating companies that try to take over market share and lose capital. This only works if they have unlimited access to debt. And so he says the second the Fed tries to take away the free punch bowl for the corporate bond market, that these corporations will fail. This is a fellow I like to follow who's a biologist in Pittsburgh. He's been on top of the origins of the virus. And really, if you follow his channel, you'll understand that it's highly unlikely that this was a natural accident, that rather this was engineered in the Wuhan lab, perhaps with technology exported from the United States, that because it was not acceptable to be doing this testing. So they went and took it over to China. And then that's when things got out of control. So a Chernobyl-like accident perhaps to begin with, but then rather than try to own up to the mistake, the Chinese instead did the opposite. If we're going to have an economic slowdown, then the rest of the world will as well. And so what did the Chinese do? Again, we have the footage. They literally barricaded all of Wuhan, which was insanely, insanely crazy to watch that video footage coming out. They also knew about the virus way back in October, based on when we believe this leaked out of their lab. Went on to let it spread in November, December. They threw a gigantic party in Wuhan with free food for the whole population, almost trying to ensure massive spread in that city before they admitted it had become a problem. And by then it was too late. There'd already been millions leaving Wuhan with the disease and turned this into a global pandemic. So I do like watching his content, especially when he exposes all the virologists who are connected to this research, who continue to try to hide the truth. So there's a bunch of biologists he's connected with exposing that truth. This is a great video from China in Focus, and we'll give you all the latest happening in China. Bottom line is that they are continuing to have second wave despite massive, massive amounts of precautions to avoid that. So we're looking at the countries that had the first wave to try to see if they are able to successfully reopen without new waves. And so far it's looking like the answer is no. This is a video that's a good 10 years old, but very pertinent in this. So you got Keynes versus Hayek, two different economists. Bottom line is, one is all about quantitative easing when you have a recession. So that's what the Fed did with this current crisis. And then you have Hayek, who wants to really do more sound economics without QE. And so there's good pros and cons of both, and we could spend a lot of time, but that's a fun watch, and we'll really give you a big picture view of the two main thoughts on how to manage an economy and a monetary system. Very good video. Now, this is a video that's from some, the hated one is his YouTube tag. He has a huge following. And so this video goes to point out that perhaps the elite are trying to create civil divide among the poor through these riots and protests and the anarchy, and that perhaps something else is happening behind the scenes. Okay, so I do think that's a good video to watch. And so at the end of the day, it's going to say that you should not be thinking that it's a Democratic Republican argument. It's really an argument of the wealthy versus the middle class and poor. Good video to watch. Obama had a speech which was potentially designed to try to quell down the riots. Last night we had some peaceful riots, but a lot more arrests. We'll see how long these go. My expectation is it's going to go much longer than people expect. But this was an interesting speech. We also had the defense secretary say that he doesn't support military action to take down the protests. We had Obama come out, so it does look like they're trying their best to calm these protests down. Now, the next piece of the news I do want to cover is an article from a famous investor that does really have a lot of meaning in this current market right here. Okay, let me zoom out. Ryan says to 100. Okay, we're back to normal view. Does that look good? Let's see. Yeah, those put prices look way too high, Rick. Yeah, Rick, we're holding those GDX puts, which are up big right now, and we'll probably hold them for quite some time. So we're really at a pivotal point in Fed policy that will dramatically change the outcome of the markets. So just to summarize, Rick, my general prediction was that the amount of debt the government has to sell in the coming months would cause the bond market to have a spike in yields, and that would cause a stock crash, which is what we want for a lot of the positioning in our portfolio. So last month, I thought it would happen by the end of last month. That's why we bought a nearly 1 month put option to protect against that. It didn't happen. So we did more QE for longer than expected, and it kept the bond market nice and happy, and we had this massive stock rally. Just in the last 24 hours, have we seen the bond market start to sell off for yields to spike, and it's happening, no coincidence, 24 hours after the Fed surprisingly cut its bond purchases by 70% intra-week, and it's already down 90% from the height of their bond buying. So this is playing out right now. So the Fed's going to have to make a choice. Are we going to do yield curve control, which means a lot more QE, could be massive amounts of QE. It could make the current QE look like peanuts because there's 16 trillion outstanding in debt that they may have to pick up if they decide to do yield curve control. Or are they going to allow the bond market to rise until it snaps the stock market? That's my expectation, is they're going to allow that bond market to rally in terms of higher yields until that causes the next leg down in the stock market. And that's when I think we're going to see another huge round of stimulus, a second wave of the coronavirus, Democratic governors and mayors refusing to fully open their economies because the death count and case count is spiking right back up. And yeah, and that's when I would like to see us really get more aggressive on equities. So this time around, looking back, obviously, much easier to realize the bond market failed at its job in the March crash, and thus we could have predicted the Fed would have to do QE. Now, in every stock crash we've had in history, the bond market did its job perfectly fine, and they didn't do QE until the problems in the underlying economy were resolved. This time around, the crisis is much larger, and the crisis did crash the bond market only a few weeks into the crisis. Okay, Ram says, how is the Fed going to make the bond market rally along with the stock market? Yeah, it's not going to be able to do both. It can either do QE and flatline the bond market, which is what it did for the last 4 weeks and has stopped, or can let the bond market behave normally and take out the stock market, and that's what will make bonds rally. So there's just two choices there for the Fed. Now, if they keep printing, then you lose the value of the dollar, which is our single greatest asset. So that's how we get away with being able to borrow trillions of dollars that we just don't have. So, okay, so let's look at this letter that came out. At GMO, we dealt with 3 major events prior to this crisis, and rightly or wrongly, we felt nearly certain that sooner or later we would be right. We exited Japan 100% in 1987 at 45 times and watched it go to 65 times for a second, bigger than the US, before a downward readjustment of 30 years and counting. Okay, so he was 2 years early on getting out of the Japanese market. In early 1998, we fought the tech bubble from 21 times, equal to the previous record high in 1929, to 35 times before a 50% decline, losing many clients and then regaining even more on the round trip. So he's saying he was a bit early on the dot-com bubble. In 2008, we led our clients relatively painlessly through the housing bust. In all three, we felt we were nearly certain to be right. Japan, the tech bubbles, and 1929, which sadly I missed, were not new types of events. They were merely extreme cases akin to the South Sea bubble investors' euphoria and madness. The 2008 event was easier if you focused on the US housing euphoria, which was a 3 sigma 100-year event, or simply unique. We calculated that a return trip to the old prices trend and a typical overrun in those extreme house prices would remove 10 trillion of perceived wealth from the US consumers and guarantee the worst recession for a decade. All these events echoed historical precedents, and from those precedents we drew confidence. But this event is unlike all those. It is totally new, and there can be no near certainties, merely strong possibilities. This is why Ben Inker, our head of asset allocation, is nervous, and this is why you are nervous or should be. While the uncertainties are indeed large, one triangulate a sufficiently material dose of certainty about what is coming. And as Graham explains further, it is not pretty, especially with the US economy already on the back foot heading into the crisis. We had US and global problems looming before the virus, an increasingly disturbed climate causing global floods, droughts, and farming problems, slowing population growth in the developed world, soon to be negative, and steadily slowing productivity gains, especially in the developed world, and therefore a slowing GDP trend. In the US, our 3% plus a year trend is down to at best 1.5% in my opinion. It's closer to 1% maximum in Europe. We had, as mentioned, top 10% historical PEs in the US and much the highest debt level ever in the US for both corporations and peacetime governments. So after a 10-year economic recovery, this would have been a perfectly normal time historically for a setback. And then the virus hit. Simultaneously, it is causing supply and demand shocks unlike anything before ever. It is generating a much faster economic contraction than that of the Great Depression. And unlike 1989 Japan, the 2000 tech, and the 2008 US and Europe housing bubble, it's truly global. The drop in GDP and rise in unemployment in 4 weeks have equaled what took 1 to 4 years to reach in the Great Depression and were never reached in the other events. Rogoff and Reinhardt, Harvard professors who wrote the definite analysis of the 2008 bust, agrees that this event is indeed completely different and suggests it will take at least 5 years to regain 2019 levels of activity. But this is a guess. We really don't know how long it will take. Nearly certain is that a V-shaped recovery looks like a lost hope. The best possible outcome would be that there will be almost miraculously billions of doses of effective vaccine by the year end. But most viruses have never had a useful vaccine, and most useful vaccines have taken well over 5 years to develop, and when developed have been only partially successful. Yes, this time there will be an enormous effort with unprecedented spending, but still, a leading vaccine expert says quick success would be like drawing successfully to several inside straights in a row. And even if all works out well with a vaccine, there will remain deep economic wounds. Meanwhile, as the world waits for a vaccine and buys stocks confident one is imminent, the bankruptcies have already started. Hertz on May 22nd, and by year end, thousands of them will arrive into a peak of already existing corporate debt. It will need speculator management, which it may get, but it may not. Throwing money, paper, and electronic impulses at the problem can help psychology, and particularly the stock market, where extra stimulus money can end up, but does not necessarily put people back to work. There will be up to 20%, we can scratch that off, 13% unemployment for at least a moment. In response to this historic economic collapse, central banks' unprecedented stimulus efforts have temporarily overwhelmed underlying economic realities, but it's hard to believe that that will continue. Well said. Okay, so I'm going to get through some more news and then take a break to the questions coming in here, and we can look at charts. So I'm interested in the media. So we went from, if you go outside, you're going to kill granny. And we had nurses literally getting out in the road trying to blockade people driving around, saying it was evil. And now they're outside clapping, massive crowds walking around in small gatherings. Okay, so you can go through and click these videos. Here they are clapping away for the protests, but in this instance, protesting people not wanting to be locked down. What gives? Anti-lockdown protests are bad, spread the virus and kill granny. You'll be publicly shamed if you take part. Black Lives Matter protests are good and don't spread the virus at all. You will be publicly shamed if you don't take part. Minnesota AG charges 3 more officers in the George Floyd killing as second night of protests begin in Europe. And they upgraded the main cops charge to first-degree murder. But the demands continue to grow from these protesters led by AOC. Now they're talking about wanting free health care. They've got a huge list of demands that builds by the day. So I do believe these protests are linked to the election and will not resolve anytime soon. Okay, so Fed unexpectedly deviates from the planned operation and buys only 70% of the scheduled treasuries. So that was a reduction, almost as if they are trying to create this bond volatility to slow down the stock market. So that was the headline 2 days ago. The other thing that this does is it creates a bear steepening in the yield curve, which tends to create a lot of these signal-based trading systems to buy up value, or in our case, load into that HYG product. So perhaps that one or two of those is the reason why they suddenly dropped that position. So here's a little note from Charlie McElligott comparing the bear steepening of the yield curve to being a positive signal for value. In our case, that would be HYG is highly correlated to a bear steepening, which is what's occurring. So my prediction at this point is we're going to have a lot of people get forced out of the bond position in the next week or two and pile into this value play. So that's what I'm expecting to happen. Our VIX position could be extremely profitable, as well as our HYG position in this case. Here's the 5s and 30s curve steepening, and that did spike much more this morning. April factory orders crashed by the most in American history, having collapsed by a record 10% month over month. April factory orders were expected to accelerate even lower and did, 13% plunge. Here's a look at this on a chart. So the stock market is not pricing in any more pain whatsoever. And again, we have not allowed the economy to see what is going to succeed and what's going to fail. We've essentially bought ourselves a couple months of time by devaluing the dollar and printing several $trillion. But they're not doing that now. So unless they want to continue doing that, I do believe this trend is at the last gasps of air. Trump administration bars Chinese passenger planes to the U.S., says they'll allow as many planes to go to China as China allows to go to U.S. China came back the next day and said they'll allow 1 flight a week. We're seeing the media team up on Trump, specifically YouTube, Twitter, Snapchat, and not as much Facebook. Facebook seems to be diverging to some degree from these tech elites. We also saw Elon Musk say we should break up Amazon yesterday, which was interesting. But Snapchat has a huge chunk of its company owned by China. Google seems to have a secret deal to be able to get their search engine into China. as well as a partnership on developing AI. So I do believe that's why we're seeing YouTube protect its relationship with China for the hope, the carrot that China will one day be able to dominate the search results in Asia, which again, currently they're not allowed to. So that's developing rapidly. White House slaps retaliatory foreign mission restrictions on more Chinese media outlets. Okay, so we're seeing both countries nationalize right now. China kicked out our media. Now we're retaliating by kicking out theirs. So this is just going back and forth. Right now, the biggest threat the US has that's on the table for China is pulling out our semiconductor chips from Qualcomm, which again would cut off the legs of Huawei, one of their largest companies. So again, if that does go through, because the Chinese are not living up to their trade deal, not even close, then what would China do to retaliate? Likely strike back on Apple, although that would hit a huge chunk of their labor force, at least 1 million workers building those Apple phones for Foxconn. Yesterday was the anniversary of Tiananmen Square, and Pompeo posted a picture of one of the survivors of Tiananmen Square, who's apparently been hiding from China, as another provocative move. It starts so soon, Pompeo tweeted. For the first time in 30 years, Hong Kong authorities denied permission to hold the Tiananmen Vigil. And again, the Hong Kongers were not allowed to go mourn the anniversary of this date, but they did. And so there's some beautiful photos out of Hong Kong. And again, a huge contrast. In the US, we have plenty of peaceful protesters with good intentions that just want to see change. But under the scenes, we have a group of paid terrorists who I believe are trying to overthrow Trump in the election, who are running around blowing up stuff, stealing things, and trying to incite violence. And so Project Veritas did get some clips of that, which at the top of this are critical to trying to predict what's going to happen in the future. Okay, Christine Lagarde surprised, instead of a $500 million or $500 billion of QE, she's ramped it up to 1.3 trillion. Now, again, that's QE to buy the Eurozone's bonds, which is in a huge mess, but that will create extra liquidity. So this is one headwind against expecting a stock crash, as we'd have, again, the ECB, the Bank of Japan, and now China all starting to copycat what we did early, print. So this should strengthen the dollar back up. Here is the Eurozone's expectations. You can see negative 8% GDP 2020 projection. To get back to even, it's going to take 2 years. So that's not a V-shaped recovery for Europe, at least in projections. And this does go into more detail. Here you go in terms of looking at these inflation expectations, and they have collapsed. So again, inflation collapse is something that you want to buy bonds for. It shows low growth ahead. Here's the picture of Pompeo with the survivor of Tiananmen Square, which again was designed to show our support for Hong Kong, the people of China, and the growing conflict with the Communist Party. And we got to ask ourselves, can we really open up all these businesses safely? Well, we've got several dead in the Amazon warehouses. We got protests demanding increased hazard pay. We have just so many stories. Every business that's trying to reopen, where people are squished in a small space, are having huge amounts of outbreaks currently. So the virus issue is not gone. The reason we had to lock down our economy is not over. It's just getting started. Here's a review of the vaccines. This is a play I do want to get into, but I'll wait likely till probably in July. So the two I'm most interested in personally are Oxford and Moderna. So Oxford University, both of these, by the way, Bill Gates owns a huge chunk of and has been pumping up. So we have AstraZeneca behind the Oxford adenovirus vaccine, and then we have Moderna, which is again just not partnered with any companies, but is invested in by Bill Gates long ago. So these are the two favorites I have that I believe have a high probability of being pumped starting around July. So they're going to go into phase 3 in July and give out their vaccine to 30,000 people for Moderna. And without question, there will be a massive second wave. So we will know probably within, I'd say, 90 days of July, whether or not this vaccine works. And if so, that would be great news. But if not, again, we're going to be back to the drawing board with reduced economic activity, lots of sick people everywhere, and reduced spending. Okay, James says, when's the Moderna trial scheduled? So right now they just started phase 2. They're going to inject 600 people. And the goal of this is just to see who's going to have a bad reaction to the vaccine. So their technology is really cool. Moderna's, it's never worked before, so that's a downside. And they've been working on this for quite some time. But they're able to essentially program their own spike protein that's copycat of the coronavirus and design an RNA that will just replicate only the spike protein in your body. So it gets a huge concentration of the antibodies created and presumably could work. So this is very exciting. The concern I have is the insider trading would indicate that the people behind this have very little hope that this is going to work because they're dumping stock as fast as possible. Some of the key people in the business have 0 shares now. So that is a concern. But again, I am expecting both of these stocks to be pumped up after they get phase 3 rolling out and into the trials when we'll see the data. So if it comes out great, these could go through the roof. And if they fail, they're highly overvalued. Okay, Ram's asking if the dollar moves. Yeah, weak dollar will be weak bonds. Strong dollar will be strong bonds. Okay, so there's a few others. China presumably is ahead of the pack. Obviously, they were dealing with this way back in October. I mean, they've been playing with these vaccines for 2 decades in terms of messing with these exact virus strains and presumably trying to create cures for them. So there's a few stocks that we can have access to that are related to Chinese vaccine developments. We'll have to do more research as we get closer to this period of time. But I think we're going to see the biggest pump in probably Johnson & Johnson, Oxford University, which is AstraZeneca, and Moderna. So those are the 3 viruses that are rather vaccines that could save the day. And let's not fool ourselves. Humanity desperately needs this vaccine once we look at what the real mortality rates are. And I'll give you my overview of what I believe the death rate is on this. So I think you'll find it that typically the Republican group thinks that the virus was a joke and that the Democrats overblow the seriousness of it. I find myself right in the middle. I do believe we must open the economy because we're going to go into a depression if we don't. But at the same time, I also believe the virus is extremely dangerous and will continue to disrupt consumption. And so that does tell us that we must get a vaccine or allow this to rip through society and have a horrific amount of deaths and an overwhelmed health system, which may not be politically acceptable. So I'll go into the big picture on the virus, and that's really the key data here is predicting that. Ram says it is dangerous. The death toll is proof of that. So yeah, we'll go into that. If we had 20 to 30% of the population had already had this and they were overstating the deaths, just saying every single death is due to the coronavirus, then I could give you the argument that no, it's not that big of a deal. We should just let this rip through society and get on with it. But if it's killing between 1 to 3 humans that it touches, then that's 10 to 30 times worse than the influenza and is devastating. And unfortunately, that is exactly where I'm finding the death rate to be. And I'll show you that math in a moment. And there's a few other. So there's Operation Warp Speed is picked 5. Again, unfortunately, I'm expecting a very nasty stock crash in the very near future because of the bond market. There's no way to get around this. The only way to avoid the stock crash in the coming weeks and months would be if the Fed comes back to QE and picks up all this massive debt that the Treasury has to issue. There's not an option as to whether or not we're going to sell this debt. We have to. So that is the big picture going into June. Okay, so this is a review of a lot of these different vaccines, where they're at. The Oxford vaccine originally came out and said, hey, this cured the monkeys. So they gave it to some monkeys. And the end data was that it didn't stop the virus from spreading, but it did protect the monkeys' lungs from dying. And so now they're rolling this out to 1,000 adults to see if it has an adverse reaction. If that's not proven to be deadly just from taking the vaccine, then they'll roll to a much larger audience coming into the coming months. So we have Oxford and Moderna really racing to get this vaccine out. Okay, so RAM is saying they do have QE. So QE is not the same as a stimulus bill. So that's important. Totally different. And I'll go into that. But yeah, right now we have another trillion that McConnell's saying he'll approve, but not until the end of July after they come back from recess. So we'll go into that. But I think it's going to be much larger because we're going to find out quite quickly that unfortunately, we're still dealing with the exact same problem that put us in this mess, and we're nowhere near the solution. Jack says, does the government want the US dollar to be weak to improve our exports during the current situation? Well, the government doesn't want the dollar too strong or too weak. If it goes too strong, you crash the stock market. If you go too weak, you crash your bond market. And so that's mainly affected by the QE that we've done. So QE has punished the bond market and punished the dollar. So this means it's going to be much harder for the US government to raise money, which again, it's not like the US economy is roaring profits. It's more like the US economy is borrowing $100,000 and then making 80,000 in profits. So they're really losing 20, but they're sitting here and saying, look, our GDP grew. And then the next year they borrow 120 and say it grew by 100. But each year they're just losing more and more money relative to the debt. So you're basically watching America blow out its credit limits right now to deal with this crisis. And they decided to deal with it, blow out the credit sooner than typically we do in history. Okay, so we have a group of vaccines, and it's a long shot. I believe these will be pumped regardless, as really the hype of a way out of this mess into the election by the Republican Party. But keep in mind, we do have a lot of these people tied to the Democratic Party behind this, namely Bill Gates. So I believe both parties are incentivized to put a very positive light on these vaccines, trying their best to create a vaccine. Unfortunately, the probability that it works, I would say, is less than 50%. So it's something very important to watch in the coming months. We have another Fed folk talking about negative interest rates being required to get out of this mess. So we did see the bond yields start to tease negative rates before the bond market snapped when the Fed took QE off the table. And my expectation is if we get a vaccine by the end of the year, we will not see negative interest rates, and we'll be able to have one more leg down in the market, and then one more huge punch of QE and what they call yield curve control, and then rip the stock market into new highs into 2021. So that I can see happening. If we do not get a vaccine, then we're in for a heap of trouble going into the next year. And so I'll go through the numbers of what's happening with the virus and what my projections are for that, because that's really what's going to uh, have a huge effect on the economy, how much money corporations can make in the foreseeable future, and how much debt the government's going to have to spend to keep these wheels moving. Okay, so here was Defense Secretary Mark Esper saying that he does not support the Insurrection Act. Now, some of the folks who are on the Democratic side of the aisle were saying that this was all fake, that this fellow has come up here, they got to go against Trump, that we had Obama come up and tell you guys to calm down because they don't want to make real change and that you need to keep protesting. The Republicans will say, uh-oh, all of Trump's allies are turning against him because they don't think he's going to win the election and they don't like the way he's dealt with the pandemic. So that's really the two views you have on this critical speech here. This, I believe, was from Axios. Okay, interesting story. So we got all this looting happening. I mean, it's just quite comical. We have a record deficit. We're gonna have negative 50% GDP. Nothing's open at full scale. Most of the states are in phase one, praying for phase two, but phase two is going to get cut off because everybody's out rioting, and we're going to have case counts spiking here probably within 30 to 60 days. But Apple's tracking looted iPhones. So these people are going into Apple stores, robbing them, and it's popping up saying, we're tracking you. So it's just comical. But what's interesting is that iPhones and Apple do like to protect privacy. That now Oscar sent me a bill from the Democrats that essentially is insinuating that if you were found to have the virus, that this new bill would give the government the power to go use your everything it can, which could potentially be your phone, to look at who you've interacted with and then go essentially force vaccination on everyone you've been involved with and potentially put them into quarantine and things of that nature. So that's a dangerous bill that is just at the House right now. Thank you, Oscar, for sending that to me yesterday. U.S. exports and imports crater the most on record as Asia refuses to comply with the trade deal. So that's the numbers that are hard to fake. You can go print money and put it in the stock market and give people a feeling of peace and calm. But does that fix the underlying economy? No, it doesn't. And so we're seeing the money velocity go to a very low number. What we want to do when we create debt and put it into the economy is see it ping pong around as many times as possible, which drives your GDP numbers up and creates real growth. Unfortunately, what's happening now is the money's going straight to the stock market and benefiting the elite 1% who own the stock market, and none of it's going into the real economy. So, yeah, the exports and imports globally are collapsing. Monopolies are wrong. Elon Musk declares it's time to break up Amazon. That's a big statement from Elon there. White House plans $1 trillion for the next stimulus. And I do believe this would primarily go to companies and to the people not the ridiculous bailout we did last time around to charities and foundations that absolutely did not need it, just political favors. But they're saying that they won't do this until the late part of July at the earliest. So now, again, Ram had a good point. Does this mean there's $1 trillion more of QE coming in from the Fed? No, not necessarily. So here's what we got wrong and what we got right in 2020. Okay, so in January, I saw that we had an epidemic in China. I saw it spread to South Korea, to Hong Kong, to Italy, to France, and they all had to do the same thing to protect their society, which was lockdown and quarantine, which doesn't take a rocket scientist to understand that will be negative for corporations. They're going to make less money. So we predicted that correctly. Next thing I predicted is that the government's going to have to spend trillions of dollars to get us out of this hole. Sure enough, started off with 8 billion, then it was 50 billion. They didn't settle until it was at 2.4 trillion. Okay, we got that right. March, we had the stock crash. We were positioned well. Everything was going grand, but then the bond market failed to do its job. And that's what I showed you earlier. The bond market and stock market crashed at the same time. So the Fed had a choice. Do we allow the collapse to occur right now at this very moment in time, or do we delay it? If we delay it, we have to bail out the US government's bond market. So they came in with trillions of QE. And that's what they've now cut off. So they're doing a little QE for the corporate bond market right now, a little bit for the mortgage-backed securities, but they have dramatically pulled out the QE for the US government bond market. So could the Fed come out today and tell us, you know what, we're going to reverse course and go ahead and ramp back up QE? They could. And if they did that, I would expect stocks to go much higher for as long as the Fed's willing to do QE. But then they risk ruining the value of the dollar, which is arguably the single most important asset of the United States. And we're seeing the weakness in the dollar right now. So perhaps that's why the Fed has had to cut off the QE. But typically, again, they wait till the crisis is over to do the QE. Put the money at the government level, let them fix the holes in the ship, and then vacuum up the debt with QE. And that's when you get that long-term recovery. This time around, we haven't fixed anything. The implications of the change to our economy have not been realized in the slightest bit. So that's what's going to play out now over the next 12 months. And will the Fed try to delay it longer with more QE and risk collapsing the dollar? Or are they going to allow the bond market to take out world stocks and fund the US government? My expectations are going to allow that bond market to have rising yields until it snaps the global equity market. And then it'll be very easy for the US government to be funded. It'll also be a very opportune time to put economic pain on China at the same moment. And so we've been watching the White House slowly tiptoe towards more aggressive policy against China. And at this point in time, I think they're just trying to get these riots under control and garner the support of our allies. So that's not the United States against China, but instead all of our partners. So we're seeing India is relying on American support as China's trying to push further and further into the Indian border. And so the further the Indians let them travel, Chinese are setting up military bases. So that's a huge conflict that's building by the moment. So right now we have Australia, India, Japan, Taiwan, and the US, and hopefully the UK and many other European countries partnering with us. It's become quite clear Germany will partner with China. In fact, there's a lot of European countries that have much more to lose with China in terms of cash flow than they do from the United States. Is this World War III approaching? Perhaps. Okay, so that's the $1 trillion that they have scheduled. And again, that's not till the end of July. But again, this is just more bond issuance the US Treasury has to issue and sell. And without the Fed, that's negative for stocks because it continues to pull money out of the general market. Okay, Department of Justice has decided to launch a formal investigation. Federal law enforcement officials are probing whether criminal actors are coordinating violent activities during protests and are looking into reports that rocks and bricks have been dropped off to throw at police and other law enforcement as cities across the country grapple with an uptick in violence. Some of the rumor mongers that I listen to are expecting that the violence is going to spark up in the coming weeks from these terrorist groups. So we'll have to keep a close eye on that. It did seem to die down a little bit last night. But yeah, there's pallets of bricks being dropped off. They're trying to figure out where these came from, but it looks like they were stolen from construction companies. So it's very hard to track. The people that are involved with this are highly organized. There's zero of their face showing, and they're coming in swiftly and creating chaos. So make no mistake, I do believe we are under attack right now. America's trying to get back on its feet before it can blow a punch right back. Coronavirus is spiking in Texas, Oregon, and Arizona. So here's the states. And again, we're already seeing the cases start to spike back up in the countries, in the states that have been the most lax. And again, riots, protests everywhere. We went from, if you go outside, you're going to kill granny, to, hey, let's go get in small spaces and protest all you want. So I expect the case counts to start rocketing higher within the next 60 days. Okay, so here we have some tweets I've picked up. Here's your, let me zoom in now. I think this will look better at the zoom in level. Okay, so here's your Fed's daily treasury purchases, and you can see that massive drop right here. This is what was unusual. Typically, they will not do QE until after the debt's been sold and the problem's been fixed. And usually that takes at least a year to occur. This time around, the losses were so massive at a global scale that every single central bank had to dump their bonds, which were up significantly, to try to cover their losses. And so, again, the Fed had a choice. Do we allow the collapse to occur right now or try to delay it? If we delay it, we have to do QE way early, and that's what they did. Now the QE, as you can see, has dropped significantly. Williams saying, how low will the TLT go before it snaps the stock market? I'm going to pull up the volatility ranges that have caused stock crashes in a moment, and then we can look at that. But I think it can go not much lower than it is currently before it will start to create problems for stocks. So yeah, we'll look at that, but I would estimate no more than another 10% decline in the TLT maximum before you would create chaos in every other market that exists. Okay, so namely that would be gold, cryptocurrencies, stocks, oil. Now oil's trading at a huge discount relative to equity. So there's a huge disparity in the value or the overvaluation of stocks compared to where oil's priced at. Oil's actually priced low right now in the grand scheme of things. So I liked the USO position a lot, even if bonds do take over the narrative here going into the election. Okay, so we're looking at inflation in this chart. And in this chart, we're seeing that we have inflation in pretty much everything the government puts its hands on. Medical, college. So everybody voting for Medicare for all or healthcare for all, just realize every asset the government's ever backstopped has had massive inflation and huge levels of inefficiency, from real estate to college tuition to cost of medical. So in this chart below, we're seeing the money velocity I was telling you about. This is showing how effective printing money has become less and less effective at real economic growth. Now, is the QE good at pumping up the stock market? Yes. Is it good at getting money into the main street and creating real sustainable economic growth? And this is clearly showing you that no, it's becoming less and less effective. Here is the chart I was telling you about with Sweden, coronavirus deaths of Sweden and its neighbors. And so you can see the lockdowns worked really well in Norway, Finland, and Denmark. And now Sweden is having quite a bit of trouble. And again, they're the ones who wanted to let it rip through society. Now, if there is no vaccine, maybe Sweden made the better choice. If there is a miracle and we get a vaccine coming into the end of the year, then all these countries that did lockdowns have saved a lot of human life, but at the cost of their economy. And so in this chart, we're looking at the same data, but a lot more countries. And so Sweden's in red. So you can see early on, everybody had a similar peak. Everybody had it come back down, but now Sweden's leading the pack in the second wave with their actions. More than 70 cars stolen from San Leandro Dodge dealership in California. So it's professional terrorism happening in the United States. This is not good for corporations or profits. We got stock market going up while the whole country's burning down, and a pandemic is just getting started. Moderna is to begin phase 3 trials in July. Oxford to test ChAdOx1 on children. So that's, again, what we were talking about, and probably the two best bets for playing a biotech pump and dump. Now, again, if they do come out with a miracle, these companies are undervalued. If they do not, then they're extremely overvalued, and especially Moderna, who doesn't have a single penny in sales, not a single penny from ever selling a vaccine. And at one point, I think their company got up to a massive $60 billion valuation. Speaking of which, Zoom, the platform we're using, is making something like 23 million in profits a quarter, I believe. And they have zoomed up to a $28 billion valuation. So that would take 100 quarters. So that's just absolutely insanity, the valuation in the US stock market relative to earnings for the foreseeable future. It's .com levels and then some. So there's another potential short for you. Zoom, it's already started to tank actually. Brazil health regulator approves clinical trials. So Brazil is too poor to lock down their society, and they have the fastest growth alongside Iran of the virus and the death counts. So that's a great country to go test out their vaccines on to see if they work. South China Sea, huge blow for Beijing as the Philippines stick with the US military pact. So there's another US ally. So what we're seeing behind the scenes is US is getting everyone to team up against China before we start trying to pick on them. This reminds me a lot of World War I, post-World War I, leading into World War II. Everybody wanted too much from Germany. Their economy was already collapsed from the war. but because they had damaged everyone else's economy, the world demanded reparations, and they just couldn't afford it. They ended up hyperinflating their currency and put the world into the Great Depression. So, are we going to do the same mistake this time with China? South China Sea war fears surge as Beijing rejects peaceful Taiwan reunification plan. And yes, Wednesday we looked at China's been stimulating the attack of Taiwan. They've built a replica of, I think, one of their key buildings and practice raiding on it. So China is trying to become an imperial power. It's not what they've done in the past. Here is the PE ratio of small caps. And again, this is the most outrageous PE we've ever seen in history. And if you go look at those FANG stocks, they are much higher than the .com levels, completely fueled by the QE, distorting markets. Okay, this was from yesterday. Bond market on the edge of chaos as the 10-year yield could blow out CTA liquidation trigger. So again, the effect is these CTAs, if they get into too much trouble in their bond position, they will dump it and put that capital into stocks. That's why we have that blow off top position and plenty of exposure to upside moves in 3 flavors. So we have GDX if the move up is spurred by QE. We have HYG if it's spurred by allowing the yield curve to bear steepen, which is what's happening right now. And then we have USO is just really a value play. Oil is just too cheap relative to where companies make money. So the USO and TLT really work well together in this environment right now. Okay, here's your NASDAQ going to new highs as their earnings projections have crashed. Now there's a little bounce here, but that's really pricing in that everything goes back to normal very soon and that no one's going to go bankrupt and that employment's going to go back to 3.5% from currently 14%. So a lot happens when you give out $2.5 trillion to the elite. You get bad distortions in the market. Here's your PMI map, and you can see just absolutely bloody. This is not the sign you want to be predicting great profits and earnings for companies. You'd much rather be seeing healthy PMI numbers as we had back here in 2018. So the exports and imports of the world are collapsing. Globalization is collapsing. Nationalism is rising. And now you've got the people revolting because of stagnant wages, unemployment. 1 out of 4 Americans doesn't know how they're going to feed themselves. And we got the stock market rallying higher. It's absolutely ludicrous. Here's the initial job claims. So we just have a lot of people with no income. And you got to realize the US economy is mainly the consumer. Here's the Atlanta Fed predicting 55% negative GDP for Q2. Again, not the numbers you want to be expecting for new highs in the stock market. Sorry, this is going nuts on us. This is showing China is out of cash. They're selling gold to pay for everything they need to import. In fact, we saw China reportedly gave a bunch of gold to pay for a shipment of oil from Iran to Venezuela, which is forbidden, and another thing the U.S. is upset about. Florida crosses 60,000 COVID. So here's this data, which will lead us into some good information. So at the end of the day, if you read this, the positivity rate is coming in right at around 4%, and they've tested 1 million people in Florida, which I believe is just over, I think, 20 million in the population. So still a tiny percentage of the population's been tested. However, that number is getting statistically relevant now for us to be able to try to backwards calculate just how deadly this is. So the CDC is trying to tell us that the mortality rate is 1 in 400. So let's just look at the data we actually have and see if that lines up or not. And I'll show you that it does not, unfortunately. For us to have 110,000 United States deaths, we'd have to have a much higher antibody rate than that number right there. So they are not telling us the reality with that figure. Okay, so let's update this. Okay, deaths United States just hit 110,000, or just under that. Okay, so at the end of the day, if we were to believe that this was a 25% mortality rate or a 0.25% mortality rate, then we can backwards calculate what percentage of the 350 million Americans must have been infected to reach 110,000 deaths. Okay, so it's easy math, and you end up at 25% of the population has been infected. Well, that's just not the case, not even close. So the case is that it's less than 4%. So we've now tested 1 million people in Florida, and that test is invasive. You have to draw blood to take that test. So I'm going to estimate that that is significantly higher than the real amount of antibodies that are floating around in the US population. So if we go to the MLB antibody data, it was less than 1%. So they took 4,000 baseball players, tested them all, less than 1% had antibodies. So depending on where exactly that level of herd immunity currently is, the mortality rate is potentially 10 to 30 times worse. So influenza, for example, is 0.1%. It's looking like the range of the mortality rate for this virus. I'm going to be careful what we say for YouTube, who's again censoring, is likely between 1 and 3% based on the antibody level being so much lower. So I'll update this for our next update to show you the math, and I'll create it so we can see if there's 1% of the population infected, what's the mortality rate, if there's 2, 3, or 4. Now, New York, the single highest antibody data was up to 20% in the epicenter. But you go look at the data in different random counties in New York, and you can find samples that are less than 1%. So herd immunity is not reached. The percentage of the population that's been infected is extremely low, and probably around 1%. And we're at 110,000 deaths. We're trying to reopen the economy. We've got riots and protests all over the country, all over the world. So I do expect this will become the key story in the coming weeks and months, alongside the bond market. Again, punishing all other markets because there's just not enough money to go around to pay for this insatiable desire for debt of the US government. Okay, so again, if the death rate was anywhere near what the CDC had told us in the last few weeks at 0.25, then you'd have to backwards calculate that 25% of the American population's already had the virus to only have 110,000 deaths. Our data is coming in on the antibody data is below 4%. So they're lying to us in a huge proportion by a magnitude of 10 times. Okay, so standing up for social injustice is great, and but my concern is who's behind this obviously globalized organized protest, who's behind the terrorism that's happening behind the scenes trying to make these protesters look bad or potentially incite them to have bad behavior, and what's the bigger story happening. So we got to keep the eye on the prize. We have an election, and we know that the current administration's policies are disruptive to the global order, to globalization. We got to remember these huge companies on the US stock exchange aren't owned only by Americans. They're owned by very rich individuals, in some cases, foreign central banks. And so their bottom line is to create profits and not to support American jobs. The current administration's been focused on trying to create American jobs at the cost of the profit margins for corporations. So that's really the big fight. And so I believe the US has been helping incite the protests and revolts in China and Hong Kong. In fact, if you listen to Steve Bannon, who I believe stepped down from the US administration so he could be working on the ground, still a wing of Trump, he'll tell you that they, with their daily podcast, they go and blow it into China against the will of China and secretly behind their firewall. So I do believe we have the US trying to create civil unrest in China as well as Hong Kong. And now, in retaliation, right after Hong Kong is at risk of losing all of its rights because of a new Chinese law called the security law, they're trying to paint the picture that the United States has the exact same problem. So, how dare us put sanctions on Hong Kong or try to punish China when the problem's worse at home than it is in China? Now, also, this fellow says, no, Ian, it's okay. So, Ian Bremer, turnout for George Floyd protests in Amsterdam, extraordinary. And you can just see there's a massive crowd. So, again, if you're worried about whether or not there'll be enough sick people to test your vaccine on, mission accomplished. Now, these guys are wearing masks for the most part, but that's not 100%. And so here was his commentary. No, Ian, not extraordinary. Here in Europe, you will always fill city squares for a rally on America's ills. Now try to do the same for a rally about the Islamic Republic of Iran slaughtering 1,500 innocent protesters, or Putin and Assad bombing the Syrians. That would be extraordinary. Here's some footage from last few days showing the state of the American economy. So is this a V-shaped recovery? Hard to argue that the US is back on its feet with healthy growth ahead. Great setup for a who needs precious metals move that chases off latecomers and fast money. Luke Roman, gold appears to be selling off on rising rates again, but that's missing the forest for the trees, in my opinion, because US debt at 120% of GDP. Every tick higher in yields brings us closer to a resumption of truly face-peeling amounts of Fed balance sheet expansion. So Luke Groman is a huge gold bull, stock bull, and believes that the Fed is going to do yield curve control early. So that's what we're talking about. Is the US has a massive amount of debt to sell. That's not going to change. That's in the books and it's growing by the day. So that cannot change. What can change is how the Fed responds to this imbalance in the markets, this massive increase in debt. And they really have two options. One, let the yields rise until it does become so attractive that money floods into US debt products. And again, that typically causes stocks to crash. Or will they immediately go into yield curve control next week? So if the Fed wants to continue expanding its balance sheet and resume more bond purchases, the stock market could go significantly higher for much longer than people would expect. Now, I don't think they're going to make that move because the dollar is already beginning to collapse, and that's a much bigger concern, is the value of our dollar. So my expectation is the yields will spike until it crashes stocks. This will be happening at the same time as more lockdowns. Democratic leaders are going to be not reopening their economy, not pushing to phase 2 or 3, and trying to create more and more pressure going into the election to help Joe Biden. That's when I perceive the Fed will do yield curve control. And then if that doesn't work because we don't get a vaccine at the end of the year, next year I could see the Fed pushing to negative rates. So if I'm wrong and he does jump into QE this week, well, we've bought that at the money put on the TLT, and the rest of our portfolio does absolutely wonderful. If I'm correct, really the only thing that's going to shine right now will be our put options on equities, maybe oil, just because it's so extremely undervalued, and then your bonds take off. So it's really the two paths we can go down. And again, I expect no QE, no yield curve control until the next leg down. China, Trump says he's not excited about anything with respect to China. Savan Henrik says the first to sell gets tear gassed. Comical. And a comment on that. So when you give big hedge funds a massive amount of money from QE, here's what can happen. They'll sit there and look at all the open positions that are at risk. So the biggest positions they targeted in the last month was everyone saying, look, this economy is wrecked. Let's short the market. And so they have caused those folks to cover their shorts over and over and over again and juice the market way higher, knowing that there was not the catalyst yet for a sell-off. We got people like James Simon, who has averaged 30% a year for 3 decades with AI, has a partnership with Robinhood, and sits there and tries to manipulate retail. So very interesting what happens when you don't let companies fail and you give the elite unlimited access to capital. You get distorted markets. You don't have a fully functioning economy. You get a bunch of zombie companies that lose money. You get very poor growth. Okay, Los Angeles high-end art store in Melrose being looted. At this point, rioters understand they can get away with looting. They will not stop destroying business until the government restores rule of law. And someone's screaming, "What are you doing? Most of the painters in here are minorities," as they break into this art store and steal a bunch of art in that clip if you want to watch that. Okay, Helen Branswell. And we're just starting to reopen. It isn't gone, folks. So here's your ICU across the country. So 60 days of a lockdown, approximately, got the ICUs to be around 60 to 70% occupied. Now we're reopening. We're doing massive protests. My expectation is these hospital systems will be maxed out within the next 90 to 120 days at the longest time range. So JP Morgan has some pretty good insights into this. They're saying, well, we're worried about a second wave. We're studying the other countries and how fast their second waves are occurring versus when they've reopened their economy. But there are some differences. One, the businesses are doing limited traffic through their businesses. Two, many people are wearing masks. And then three, pointing out that there may be a large amount of herd immunity. But again, we've looked at the data. There's less than 4% of the population has this. So it's relatively no herd immunity. And people aren't taking it serious. They're all coming out to have a little relief. Okay, things China doesn't want you to know. Here's the Tiananmen Square So 2019, we had, I watched this live, their big show of force. They brought out all these nuclear deployments, which are these machines right here, right where the Tiananmen massacre occurred. So they had this huge event. It was terrifying, to say the least, when you look at what China's ambitions are. And then you can see in the left picture all the dead bodies scattered all over the road. And here's another photo from that. This was the protest back in 1989. Some of the photos, and again, Western democracies look the other way for the last 3 decades. Who cares about the Chinese people? We want to get rich. We want to take advantage of cheap labor. And now we've grown a monster that does indeed want to imperialize. Some footage from New York. It's just chaos. There's no end in sight. Okay, today is a temptation of the movement to see if they can stop you before you get actual change. They charged all 4 men. Secretary of Defense parts ways with the president. Send out Barack Obama to soothe. What's the one thing missing? Actual change. So we've got a clip from AOC. And she's going on and on about all the demands they have, including free healthcare, all sorts of stuff. This lady's screaming to get on your blank knees to the San Francisco cops. Absolutely ludicrous. So there's another good clip you can watch. Mom and pop pharmacy decimated in the Bronx. So yeah, V-shaped recovery. This has just gotten absolutely out of control. Men with bats roam the streets in Chicago. So police won't do it. Now the civilians are starting to get violent and trying to protect their areas. Looting in Santa Monica. Now, can you hear the audio on that, Ryan? Or team? No, let me try to get the audio on there too. Okay, now can you? Hey, ain't nobody got that. Okay, we'll have to test that so we get audio in the next one, the next update. Okay, scene in Oakdale. It's just chaos all over the globe. Here's a clip from DC. This one's peaceful, so that's good. Now this was comical clip. We've got I believe, BBC reporter trying
Taking now to London, where thousands of people are gathering in protest as we go to air. And Europe correspondent Ben Avery has more. Ben, there've just been some clashes with police. What's happening where you are?
I fuck the media.
And so there's actually a bit of a clash with us here at the moment. And pretty soon the reporter is now looking at.
Okay, guys. So what's happened? We've been trying to walk away from the danger here, but it's been following us.
Goodness me, I mean, this just goes to show.
So again, you guys can go to the news tab and spend more time on the news today.
Okay. I mean, that just goes to show how dangerous it is.
chased out of the protest. Euro surges after the ECB expands its emergency QE by 1.3 trillion. Okay, Jim Bianco, how much are we driving as of last week? About 75%. So a lot of people are looking at transportation data to have a good inclination of how much of the economy is really back to normal. So right now, this would indicate 25%. Despite being banned for the first time in 3 decades, the people of Hong Kong held a vigil tonight in memory of the lives lost in Tiananmen Square. Everything was peaceful until these plain-clothed cops decided to arrest some Hong Kongers. And by the way, the Hong Kong dollar's at the strong end of the band. And if it just goes to the weak end of the allowed band, that's 100% gain for our boot campers. This video, this crazy person got this. I'll show you the clip. He takes this and rams it into a Macy's. So V-shaped recovery right here. Boom. There it goes. So perhaps this is why Trump is waiting a little bit to retaliate on China for what's clearly an attack. And at the same time, while all this is going down, China's making power moves. They have passed a law that strips Hong Kong of its power. They've turned down the peace treaty offered by Taiwan and made threats. They've put massive tariffs on exports from Australia to try to cripple their economy when they just simply wanted to get some researchers in to figure out what this virus had originated from. And all the while, lots of mockery. I guarantee the funding for all the terrorism in the United States is directly associated to China and George Soros. 1 in 4 Americans skipping meals or relying on food donations during the pandemic. So we're able to get $2 to $3 trillion injected into the stock market, but we can't keep Americans fed. Chinese people, this is propaganda from China. Chinese people did not forget what happened in the Tiananmen Square 31 years ago, but we have changed our understanding of the incident through many such comparisons. Okay, so here's their little clip for you. And so they want to point out that the NYPD is just going to drive right through the crowd. And this video below, they show how their tanks, just like the tank man, stop that. Today in Hong Kong, pro-democracy politician Ted Hui tried to stop a vote on the national anthem bill. Oh yeah, that's the other thing. If you don't sing the Chinese national anthem in Hong Kong, you can be arrested. So one of the people protesting that spilled some nasty fouling smell as they're voting on it. Anybody who disagrees with the Chinese party gets just ejected from their parliament now. Jim Bianco, the airlines are now up 65% since Buffett sold all of them a month ago, and wish them well. Meanwhile, the Robin Hoodies tripled their holdings in the ETF jets at the same time. Who is the smart money? Okay, that does get us through the news. Let me pull up the chart tab so we can look at what kind of yield move could be devastating to stocks. And then I'll take any other questions. So go ahead and start pouring in your questions, guys, but let's just take a look at that specific chart right now. Okay, so the general theme for the bond market is that the larger the US deficit grows, the more sensitive it becomes to changes of interest rates. And so I would argue that the change of interest rates that caused a crash in 2018 is plenty of a move to create the same situation here in 2020, and especially because the outlook for bonds are beautiful and the outlook for stocks are horrendous. Okay, so Ram says, can you explain the difference between QE and stimulus? Okay, so the government can come out and say, we're gonna provide this stimulus bill for $2 trillion and we're gonna give it out to XYZ. So then they pass it and the Treasury has to go issue that money out. But where does that money come from? So that's where people, especially Democrats, don't realize that, we don't actually have any money. U.S. government is borrowing. So the U.S. government runs at a deficit. It means it spends more than it makes. And that has been the key to the U.S. GDP growth ever since the last 4 decades. And it works until you get interest rates to zero and you get debt levels unsustainable. So that's what we've done in America exactly. We've pushed consumer, corporate, and government debt to the highest levels since World War II. So that's the big problem. And that's why I always bring you back to 1929 for a depressionary period, deflation, which is what Ray Dalio believes the world's headed into, sparked by deglobalization, a decoupling of the US-China relationship, too much debt at every major developed country, whether you look at Japan, China, Europe, or the US, we're all buried in historically high levels of debt relative to GDP at the worst possible time. Now our GDP has been crushed. So that's stimulus. Quantitative easing is when our central bank prints money. Okay, so if you print too much money, it upsets the bond market and the stock market loves it. That's the fine balance that we have to watch. So let's just look at some of the interest rate changes that have caused trouble in the past. So I think the most relevant short-term one to observe perhaps is this move. So we went from Trump's elected, and he's going to go ahead and punish the bond market with tons of debt and do corporate tax cuts. So, and at the same time, the Fed's going to get brave and try to hike interest rates, and at the same time, do the opposite of QE. So we went from a high of 16% to a low of 8% over the stretch of 2 years until you collapse the market. Or if we look from this point, which I think may be a better range to measure, this is when the Fed actually started doing those rate changes. We had a decline in the TLT of 12%, and it wasn't even that much. So I think anywhere from a 10 to 20% spike in yields will get the chain reaction started. And so could that occur in June? Absolutely. It could begin next week. Looks like it already is. Here we go. So you can see this super healthy stock market. We've got record low unemployment. We've got competitive tax rates for corporations to bring jobs to America. We had a trade deal with China. You just couldn't have a better situation. And bam, the bond market snapped the stock market. And immediately in 2019 and onward, the Fed capitulated. No more rate hikes. And next thing we knew, we had massive QE and we've had extreme volatility in the stock market. So here we are once again. Let's look at the change of the interest rates. And we'll look at a few different areas here for what this move has incurred. Now, if we had a healthy rebound and we weren't doing massive deficit spending, and we had a vaccine, this would be a different story. But instead, we have a distorted market. We haven't sold anywhere near the amount of debt we need to for all the stimulus. In fact, we did a little gimmick. So how did we get the Treasury $2.5 trillion it didn't have in a moment's notice? We printed it. That's what we did. So right now, if we just look perhaps at this level on the TLT, we have a 9% decline. I would bet that this cannot go down another 10% without taking out the stock market at a maximum. Okay, Williams says, how can interest rates go up when the Fed rate is close to zero? Okay, so there's really two parts of the bond market that's critical to understand. So let's go to the economic tab. I'll walk you guys through that. So there's one part of the market is just all the outstanding debt. So right now, the portion of US debt that's held externally is $16 trillion. Okay, so that's what's at risk to agitate and cause an even bigger problem if we allow yields to rise too much. Okay, so the interest rate that we're watching every day on the yield curve is the market fighting over that outstanding debt. So that's old debt that's constantly being pushed up and down in terms of yield. So the greater the demand for our outstanding debt to be the holder of that debt, the lower your interest rate goes. The less demand there is for that outstanding debt, the higher the interest rate goes. So that's part one. Part two is understanding that the addition of debt is what the Treasury has to deal with, as well as the Fed. So let me get to that Treasury page. So this is the financing that the U.S. is looking to sell next week, just next week. That's over $300 billion the U.S. government needs next week, and for every week into the foreseeable future, it's going to be this much or more. Okay, so that's what I was predicting was going to be the big problem for the markets. So when we go issue this debt, JP Morgan and central banks get the first, so it's the primary dealers, which are JP Morgan, central banks. There's about 30 or so banks that have the exclusive right to buy the initial issuance of US debt. And that interest rate is going to be whatever the current market is pricing those interest rates are worth. So if we have yields spiking, two things are going to happen. Number one, all the bond holders, which is $16 trillion worth of rates or of treasuries, are going to be seeing two things. One, perhaps their yield is now lower than what they could get with a new bond. And then two, they're going to see that, okay, so there's three things to worry about with the treasury market. Number one, if yields are spiking, those who already hold debt are going to see that their yield is potentially lower than new issuing debt. Two, the value of their bonds have dropped. So if they wanted to exit that position, they would lose money. So they're going to be showing a loss. And then three, if they believe inflation is going to rise, then the yield that they are locked into may not be sufficient to pay off the inflation hitting the market. So that's why you can't do too much QE and you end up causing yields to spike and the dollar to weaken. So sure enough, that's what's occurred after we did that QE. So if they keep doing QE, most likely this will exacerbate. So that's the two parts of the market. So part one, you have the outstanding debt. People fight over that as to the who gets to hold it. And they're betting on whether interest rates are going to go up or down and whether the yield is sufficient relative to inflation. And so absolutely positively, the United States cannot allow the bond market yield to go too high. It will be devastating to not only everyone holding the 16 trillion in debt, who are using it primarily to hedge against downside risk, but also for the United States government to finance this trillions of deficit at a low interest rate. So does that make sense? Okay, Jack says, what's high for a yield? That's relative. And let me pull that up so you can see this over time. Okay, so this is going to pull up a history of the yield curve. And again, we're playing the 20, 30-year treasury. Okay, so this begins in the 90s, and you can see way back then we had 8% yields. So that's great, right? 8% a year, hard to beat that. So if you can get 8% a year, and you believe inflation will be far less than that now, again, leading into this period, actually, we were looking at 8 to 10% inflation because we'd done too much QE after post-World War II. Lots of free money for everybody, social mania, and you end up with runaway inflation. And so with this setup, you can get 8% a year. And if there's a slowdown in the economy, those yields tend to drop. In fact, we've looked at that. Okay, so that's a beautiful yield. What can you get today? And what has the yield done on the bond market since Paul Volcker? It's just gone lower and lower and lower. So we're looking at 8s, and you're going to see over the course of time, this has just slowly but surely gone lower and lower and lower. So we get to 92, we're in the 7s. Get to 93, we're in the 6s. We're in the 94s, we're still in the 6s. It jumped to 7.5. Now we're down to 5 in the 90s. Let's see what happens when we go into the dot-com bubble. Okay, so we're in the 6s. We're still in the 98. Okay, so it's getting into the 5% yields, 5.5. Okay, 1999, we're at that 5.6, 5.5. We're about to enter a stock crash. So we're at 6% yield. What's about to happen? It's about to get crushed lower. So again, it's rising into the crash. So let's see, our low print was 5.5 up above in the 99. Once we get to 2000, it's spiking up slightly to 6.3, 6.36, and now we're coming up towards the dot-com bubble. We had a high print of 6.7. Now remember, stock market was screaming up this whole period, highest valuations of stocks until now, and then boom, we're going to go into the stock crash. Let's see how low these yields drop. 5.7, 5.8, 5.7, 5.6, 5.8, 5.7, 5.6, 5.5, 5.4. Again, this would be your TLT going up as we're getting into the crash. 5.5, 5.3. I think our low print was 5.2 right here in 2001, March 22nd. Okay, now we're getting back into a recovery and fueling the next bubble. So I'll just kind of zoom in. Let's see, we get to as low as 5.2 on this print. So that was a pretty serious move. To put things in perspective, right now we're just hoping we go from 1.4 to 1 to push the TLT up to 180. So that gives you a feel for just the massive move in just this course of history. We've gone from 8 to 5.3. And for us to make a massive gain right now, we only need to go from 1.4 down to 1. And I do believe we're going to go way below 1 because of the magnitude of this crash. So we'll keep going Now we have the 20-year. They've switched from the 30-year to the 20, and we're seeing just a general expansion of debt. And the method for this is to drive yields lower. So the only way the US government can expand its level of debt over the course of time is to drive yields lower and lower and lower. And because the people who buy these bonds have a profit on the bond, the lower the yield goes. So they want to buy at the high yield, enjoy that nice yield, and then sell the bond after the yield's dropped for another profit. And so that's the mechanism for how the US government raises more and more debt. And let's look at the 2008 crash. So leading into 2008, we're sitting on 4.5%, 4.3. And as we get into the crash, we're going to watch this drop 4.6, 4.5, 4.4, 4.3, 4.2, 4.1. Okay, boom. Here's where they came in with QE at this very moment. Okay, in fact, they just announced the QE, and this is when we're going to bottom out. And now you can see those yields rise back up a little bit. Oh, sorry, I was on the wrong year. So here we are at 2008, dropping from 4.5 down to 2.6, a massive rally in the bond market during the 2008 crash. Here's where they came in with the QE, right at the end here. And that's when you get your spike in yields. We'll get up to, I think the highest we got in the next rally is, let's see how high we get back into the 4s. We're coming out of the great financial crisis now and into the current rally. So we're going to see yields spike up to as high as 4.5. And now we'll zoom into the future, and you can see the strategy to keep the American economy growing has been a massive expansion of debt. And this expansion of debt has only been made possible by driving these interest rates lower and lower and lower. And as we progress through time, the stock market has become hypersensitive to any change of yield. And why? The reason why is because everyone who owns the debt, if the yield spikes, they're losing money, which can cause liquidation. Okay, so let's look at the current period. So I'm going to zoom up to 2000. Let's go to that 2018 period in October, right before the Christmas massacre. So here was some of the high prints leading into the 2018 correction. So we saw as high as a 3% yield. I think this actually got a little bit higher. I think it touched 3% on the 10-year for a split second, and then you get that pullback in the US equity market to close out the year. So, okay, there's your 10-year hitting 3% and your 30-year hitting 3.4. That was enough to create a huge shift. That's when stocks were ripping higher. Everything else was getting destroyed. That was your Bitcoin crash, emerging markets crash. US was the best. Bonds were getting in trouble until they weren't. So that's when we were, as Karen pointed out, trying to hike interest rates and reverse QE. And you had a little bit of a fit in the yields, and it created that stock crash right there. That's when the Fed immediately went to lower interest rates, and then soon after QE. So let's just see where we're at currently. We saw that yield during the March crash. We get to 2020 March. So here was that beautiful print. Okay, now this should have gone much lower and protected every investor holding equities, but it didn't. The losses were too massive. There was a dollar shortage, and everybody had to sell their bonds to cover all their margin calls. And then we're talking about big hedge funds, big central banks. And then we had to bail out the bond market with QE. And you can see that massive spike in these yields. And let's look at where we're currently at now. So now we're watching those yields spike once again. And I do anticipate the exact same issue to occur. Okay, William says, so TLT. So the key here is the larger the debt, the less the market will allow yields to spike before it creates chaos. And so the debt levels are expanding very, very rapidly right now. So to be clear, I was expecting this risk last month. It's happening now. And I do not think it will last for very long before it creates essentially a stock crash and a massive bond rally. It's either that, we have really three options. One, the Fed sits back and lets the bond market crash and then takes down the stock market, which I think is what they have to do before they do more QE, which they will call yield curve control. That's one. Two, they could convince the government to stop selling debt. That would solve the problem. But what would happen if we stop selling debt? Well, then we can't finance all the bailouts. So then the stock market crashes. So that can't happen. And the government's never going to do that regardless. The third option is to pick back up QE right now. So they could announce that they're going to pick back up a little modest QE next week and try to be moderate with it to keep this growing. But now we're seeing the dollar start to get attacked. So my expectation is no intervention from the Fed now. Let the stock market sell off, knowing it will take out the global stock market and allow the government to sell this massive amount of debt it has. Probably we'll see a lot of action against China in the coming months as this plays out. And then we can get the stock market to a more organic level that makes sense, that can be long-lived and attract buy and hold investors, not speculators who think we can pump the market up for another week just because we have all this excess capital and we don't care what the profits and earnings are of corporations. So that's really the big problem with QE is you allow massive amounts of capital to be wasted simply to create profits in the stock market with no economic benefit to America whatsoever. All right, guys, so we did go for 3 hours now. Let's go ahead and see what other questions we have. Let's just review our positioning one more time, and I'll let you guys out for the weekend. So we have a balanced portfolio, more so than we did prior, as I did not anticipate such massive QE so early. Looking back, we can understand why they did it. They delayed the inevitable, but I don't believe they will continue. So that's really our big expectation right now. But if I'm wrong in this setup currently, very little pain. So we've bought an in-the-money put on TLT, or near the money. So if I'm wrong and the Fed decides to keep doing QE, HYG, GDX, and USO will all do very well, and our VIX put options will also do very well. The TLT has locked in its maximum loss because of that put option we purchased. Marlene says, do we anticipate TLT to reach all-time highs? Yes, absolutely. It has to. It has to reach all-time highs, or we're not going to successfully sell this debt, which is what's fueling the stock market and the recovery. So if that fails to accomplish new highs, then you will not have your government debt sold, and you will not be able to make this stimulus plan work. Okay, so again, if the Fed says, you know what, we're not ready to let the market work naturally, we need to intervene longer. They do more QE. Watch your HYG, GDX, USO positions do quite well. And TLT, again, we've locked in the maximum loss with that in the money put. Okay. If I'm right, however, and the bond market's allowed to perform how it organically would, we're going to see yields spike until it takes the stock market out. If that's the case, Once again, we have puts under HYG, GDX, and USO, protecting the downside risk on these, and our TLT does quite well. What else will do well are our speculative put options, which are right here in step 4. And for older members, this set of 5 SPY puts. Okay. Now, again, if the knee-jerk reaction is for yields to spike and another jump up in the stock market, how are we going to make money? The VIX put, and then most likely HYG and USO. I would presume GDX will not do well without QE. So that'll be something to watch next week. But remember, you have that, many of you have the 35 strike on GDX. So Jack says, so the government will let the market crash. So there's 3 markets that they're trying to protect, Jack, really for: real estate, which is why they've been buying up mortgage-backed securities from banks. That's the biggest market, or one of the biggest markets. The currency market's the most important. So first and foremost, they have to protect the value of the sovereign currency, the dollar. That's the most important asset, and the main reason why they can't do unlimited QE. So that's one market they're protecting. But right now, the dollar and the bond market are crashing. So if you think the government wants to protect that, their model for protecting it is to stop intervening. Just let the bond market do its job. Okay, so I believe they've tried to protect the stock market with the stimulus, and at least delayed the pain. They have not stopped companies from going bankrupt, but they have given companies a good 2-month window to figure things out with a lot of forgivable loans. So that's what's at risk. If they want to continue doing QE, all 3 of these assets do well. If they don't do QE, my expectation is we have another volatility spike in TLT, and you're going to see HYG and USO scream up with the VIX. And I would not expect GDX to do well. Now, you got folks like Luke Groman saying, well, every tick higher in the yields is another tick towards the Fed's next round of massive QE. But let's look at when they've been willing to do QE. It's not when stocks are at all-time highs. They've only done rate cuts and QE when the stock market's crashing. So it's very hard to argue that they're going to go do a massive amount of QE right now, which it would have to be about at least 100 to 300 billion a week just to soak up the bond issuance we have coming down the pipeline. So the dollar's under attack, the bond market's under attack, the stock market's under attack, and the real estate market's under attack. The Fed's done a decent job trying to protect everything at once, but the bottom line is your economy's been disrupted. So until you get the labor force back to work, and we're not scared about dying because we're 6 feet within another human being, we're going to have a slowed economy. And to think otherwise is very foolish. So that's our positioning. And finally, everything started to play out as expected, a month delayed on the TLT, admittedly. And I did not foresee the massive QE done a year early based on historic precedent. So that created some volatility. But the key is those SPY puts I gave you have lots of time premium. We did not bet the entire house, and we stand ready for the next big move. Also, we do have a good judgment as to what the Fed may do in the next leg down, which could be another massive round of QE, and which they will call yield curve control. Okay, Marlene says I've allocated 100 shares of TLT, 100 shares of USO. But I don't hold HYG or GDX. Would you recommend I reduce my position in TLT to add 50 shares of HYG and GDX? I like HYG for next week much better than GDX because I don't think the Fed's going to do QE. Now, if you think the Fed's going to do more QE, then I would prefer GDX over HYG. And quite interesting, it does look like allowing this snap in yields in the short term will help drive a lot of capital into the part of the market that's been slacking, which is that the middle portion of America, which has been shut out and had an unfair situation relative to your Walmarts and Amazons of the world. They're allowed to keep open this whole time and take over massive market share, while the rest of America was forced to be shut down. So this bear steepening of the yield curve is highly correlated to usually a real recovery, which is insinuates that you want to buy the Russell 2000. But as we've noted, there's a huge distortion in the market, leading one to believe that we have a full recovery in the economy and that the stock market will be back to 2019 profit levels by the end of the year and go into new higher levels of profit into next year, which is absolute insanity. It's not going to happen. So we have this massive distortion. It's really confusing investors. It's caused drawdown in our portfolio on those SPY puts, absolutely. But again, they can't do it without wrecking the dollar and the US bond market. So we'll see. We'll see if they're going to keep doing QE. I don't think they will. I think they want to let the bond yields rise, get another pump of money into the Russell 2000, including the bond market and stock market, and then allow this to reprice lower before they go into the next round of QE, which I do think will be timed perfectly with an even bigger stimulus plan that could include infrastructure. I think they're going to have to start looking at ways to create more money velocity, so we could potentially see a lot more money going down to people. So that whole idea of getting 2,000 a month may not be off the table. So we'll see. We'll have to watch what kind of bills the House starts passing around once we have more chaos. Right now, everything besides the riots and protests and massive unemployment, people feel calm right now because of the quantitative easing. Yeah, I saw that report, Tom. I didn't quite understand or have time to dig into it. So Tom pointed out this was on Zero Hedge or Twitter, I think. And I didn't post it because I wanted to look into it, but there's some checkbox that could be affecting the unemployment rate data. How distorted is unemployment percentage, 19 to 13%, because those filing for unemployment who check the box for not looking for work because they have not a non-COVID era viable business. So yeah, there was something coming out about the way this was filled out that could be making that number look a little better. But the bottom line is we didn't allow businesses to fail at the cost of expanding the US government's debt. So we just don't know how bad unemployment's going to get because we have not given companies a chance to succeed or fail. And so that's what's going to come out in the next 6 to 12 months. And again, if we have to worry about getting sick and have restaurants working at 25% capacity, things of that nature, well, most of these restaurants barely break even when the house is packed, much less working at 25%. So if you just have a small percentage of companies fail, that puts immense pressure on all of the related industries. So now all of a sudden, all those employees don't have income for rent. And now you have commercial and real estate, private real estate defaulting. And so it's just a domino effect. So yeah, this is a very bad situation. There is no V-shaped recovery and we have no vaccine. The underlying disease slowing our economy is unfortunately just getting started. It's horrific. It's so horrific that we did something the US has never done. QE, 1 week into a crisis, or rather a month into the crisis. And when we bought those puts, didn't look like the Fed was going to be willing to do that extraordinary move that they did. But they've done it. We've survived it. and the economic situation remains exactly the same, except we now have no trade deal with China and look to be ready to pick a fight with China leading into the election. All right, guys, let's take any last questions and then we will see you back on Monday. Okay, very good, everyone. I really appreciate your time. We'll see everybody back Monday, same place, same time. Don't forget, if you have that lifetime membership, we have a special webinar Tuesday. Thank you, Oscar. So Oscar's right there in Florida, so he has firsthand knowledge of what's going in and out of these hospitals. So I've been pinging him a little less, expecting that the hospital flow would be reduced after 60 days of a lockdown. But now that we're reopening the economy and protesting all over the place, we'll start looking in for some firsthand knowledge of how these ICU wards are looking in the coming weeks and months. Okay, guys, thank you so much. We'll see you back on Monday.